Good morning, everyone. I'm Jason Fernandez, and welcome to our Investor Day here in New York today. I want to go over a few housekeeping items. Our schedule today should be roughly as printed. Of course, we are starting about 15 minutes late today. Our speakers will have about 45 minutes for their presentation, including any questions. And during lunch, we will be having a brief news clip on the Aussie property short. Coffee and tea will be refreshed in the break room behind you there. Restrooms are located, men's out the door to your left, women's up the steps and straight ahead. We will also have several printed handouts after the meeting available to you at the registration table where you registered this morning. And if anyone is interested in watching Bill's Real Vision interview with Grant Williams, feel free to see me and I'll be more than happy to send you the link to his interview. And I will also be available to answer any questions or concerns that you may have at our Investor Day today. Without further ado, Mr. Bill Strong.
Oops. Thank you, Jason. Some of you here this morning will understand that it is with special joy and gratitude that I welcome some very old friends, colleagues, and fellow veterans of the investment wars of the last decades to Eschaton's New York Investor Day. I have to tell you, I am genuinely moved by some of the memories that the faces in this room evoke in me this morning, and I thank all of you for coming. I have to also tell you I am moved by the year-to-date performance of our fund, which is a surprising large decline, especially in the last, or even in last month. Year-to-date, our fund is down almost 20%, one of the worst drawdowns of my career. All of which has been quite surprising to us. I use that word because with few exceptions, the fundamentals of our investments are progressing as expected and are generally quite positive. So we're devoting the program this morning to trying to make some sense out of this unexpected development and also mention some opportunities that we think it creates. Now, Eschaton Opportunity Fund is a concentrated, discriminating, deeply contrarian portfolio focused on extraordinary business fundamentals, anything, anywhere, long and short, as long as it's significantly mispriced. This investment strategy is basically unchanged from the 40 years of my value investing career. And as in earlier periods, this one is very cyclical. With the rolling over of the credit cycle, and we're especially enthusiastic about our current portfolio, and as a result, those of us investment professionals are leveraging some of our own personal wealth into Eschaton at this point in time. Now, today's theme is a play on words from Jean-Marie Eveillard's new book. His book is entitled Value Investing, It Makes Sense and It Works. And by the way, if you haven't purchased a copy, I'm sure he'll help you do that. I highly recommend it. It's a memoir that's really worth reading. But we think value investment is not working. And though it still makes sense, we don't think it's working these days, and we're going to talk about that this morning. We submit that value investing devoid of valuation is literally nonsensical and hence unsustainable in the long run. It's our intention today to demonstrate that valuation has become somewhat irrelevant, maybe even perverse, to investment success. We emphasize with David Einhorn, when he wrote recently about Greenlight's bad performance, the market is telling us that we are wrong, wrong, wrong. We know the feeling. But the interesting thing is that we're not wrong. And I presume Einhorn isn't either. As of this year's developed, the fundamentals underlying almost all of our themes are progressing nicely, and yet exactly none, zero, of the 10 diverse asset classes, locations, industries, long, shorts, 10 of the themes in our portfolio, not one is working. This is either a perfect coincidence, or we're perfectly incompetent, or there's something systematic going on. It seems like investments that worked well for so long continued to attract inflows, and those that didn't have been sources of liquidation. In other words, momentum, both positive and negative, has continued at least until very recently. Logically, this is the worst possible environment for value-seeking contrarians like us. While momentum's almost perfect correlation makes little investment sense to us, it suggests markets, if and when they turn, may all work simultaneously like they did after the dot-com bubble. Chris Cole, the thoughtful, erudite option trader and letter writer, recently penned, "Value investing has had the longest period of underperformance in history when compared to buying whatever is hot. Deep value significantly underperformed momentum just prior to recessions in 1999 and 2007. If you're old enough, you may remember the December 99 Barron's cover article, 'What's Wrong, Warren?' The article asserted Buffett's value strategy was old-fashioned and he was, quote, losing his touch. Recently, the Wall Street Journal has printed several similar articles discussing how active managers are underperforming and losing assets due to stubborn adherence to value principles." We're going to have time this afternoon, this morning, we're going to spend a few minutes looking at our portfolio and going through some of the themes. We'll do that at the end of my presentation. Now, talking about poor performance, I want to explain the substitution of our portfolio company presentation today. Source Resources is the dominant Western Canadian sedimentary basin proppant, and that's frac sand supplier, with a virtual logistical monopoly. As such, we believe they will enjoy an unusual pricing power re their E&P customers. This is demonstrated by the multiple attractive new contracts they've signed, and the sand users are starting to use these contracts next year. Source is basically a new company formed by the merger of two sand mines and a very impressive logistical network in Western Canada. It is also the winner of a bearish trifecta. Number one, it's in the energy business. Number two, it's in Canada, where recent pipeline shortages are creating chaotic markets for hydrocarbons. And number three, it's an energy service company. Compounding those negatives is their unsatisfactory consolidation and development efforts, as demonstrated by their most recent disappointing results. The combined consequences is that the stock price has been a disaster. It's down over 60% for the year to date, and it's now trading below 40% of its tangible book value. We think the stock is amazingly cheap, and we're hopeful that next year these new contracts kick in, their earnings power will be demonstrated, and we hope they will validate our investment thesis so that we can showcase them at a later investor day. If you want more information, you can ask our energy analyst, Lilia. In the program this morning, we will demonstrate the investment dysfunctionality of valuation in a general way and in specifics. We're delighted to have Steve Bregman join us today. He's going to talk about indexing and other things that are doing price discovery, affecting price discovery in the stock market. Steve Rawl will talk about the topic of valuation extremes that are offering short opportunities, and Lilia will introduce our company guest, City of London Group, as an example of an outstanding business in the hugely unpopular investment space of emerging markets. Several years ago, I had the good fortune to revisit the site of the Oracle of Delphi in Greece. Inscribed on the temple of Apollo, shown here, is the famous slogan, "Nothing in excess." For the ancient Greeks, nothing in excess was, and maybe the, essential virtue. The normative elements of moderation, temperance, and reasoned restraint infused their worldview. And by the way, I would remind you that Benjamin Graham was an avid classicist. The visible manifestation of this value is apparent in their art. Look at this beautiful Greek sculpture. Their aesthetic embraced proportion and balance to demonstrate an idealized vision of reality. Let's fast forward several millennia to the 21st century. How things have changed. Today, excess is ascendant. Moderation and temperance have long since vanished. Reasonable restraint has disappeared. Proportionality and balance have been replaced by the opposite. And incidentally, this gentleman and his wife have just done the commendable step of launching a large charitable foundation, one of which the stated goals is to end all disease. Let me provide a quantitative example of modern excess from the world of finance. Have you noticed that somehow financial quantities have leapt an entire order of magnitude recently? Take personal net worth. Millionaire no longer impresses. Today, billionaires, even three-digit billion-dollar wealth is commonplace. Market capitalizations, too, have jumped an order of magnitude. As we all know, recently, Amazon and Apple, two wonderful businesses, have crossed the $1 trillion market cap for the first time ever. But the number that I'm starting to see more often that really gets to me is this one. Yes, that's 1.1 quadrillion yen. Do numbers of this scale have any reality to human beings anymore? Well, this one should. To wit, the massive volume of debt, about twice the size relative to GDP as profligate Italy, goes entire days in Japan with virtually no trading. How can that be? Simply because the Bank of Japan has bought up almost all of the tradable supply. Also included in their massive quantitative easing is about half of all the Japanese equity ETFs. Now, it's been my experience over 4 decades of investing that credit expansion and contraction cycles underlie asset bubble inflations and deflations. And you see here, this is pretty much my career. Starting in the 80s, the ascent of the Japanese bubble, housing and stocks in the 80s, and then peaking in the late 80s, early 90s, and rolling over. This is the Southeast Asia bubble, which we were very much involved in on the long side. The U.S. housing bubble is this little green line here. The Spanish housing bubble, much bigger than most people think, in the early 2000s. But here's what's interesting today. Look at where the bubbles are forming today. Everyone knows that China has expanded credit dramatically over the last decade or so, and that line is very sharp and very steep, and so it's not surprising that China is a credit bubble. But the other two are interesting, Canada and Australia. Most people are not aware of these credit bubbles, but we obviously can talk about it because we have a short in the property markets that those bubbles have created. Also, I'd like to point out to you that if you pay attention to the black line, the black arrows here and here and here, the black arrows are when credit bubbles created a financial crisis. So there was a stock market crash, a real estate crash, something. Notice that the black arrows are not at the top of the cycle. Whoops. They're as the cycle begins to roll over. As credit growth slows, it's still rising, but the crisis happened as the credit bubble slowed its growth and rolled over. As you can see, most credit bubbles contract after their peak, but after the global GFC, pretty soon thereafter, it was succeeded by what I call the mother of all credit cycles, encouraged by all the developed central banks in the world. The global monetary policy experiment of the last decade is for sure an order of magnitude bigger than any other credit cycle. The scale and duration of the recent global quantitative easing, zero interest rate, credit expansion dwarfs anything ever seen or imagined before. Amazingly, even a decade after the bottom of the last contraction, with most economies operating near capacity, low unemployment, some of these policies, we still have negative interest rates in Europe and Japan, even to this day. But those policies are now in reverse globally, which we believe will be the decisive event in modern financial history. This is what the credit cycle in the United States has done over the last 20 or 30 years. This is the result of credit expansion, which is now the U.S. household versus U.S. household net worth, the value of assets versus the GDP. If you take this line back 20 or 30 years, the blue line oscillates back and forth and is pretty much in the same line with the orange line as it should be, because it's the growth of GDP that creates the value of assets. And yet you see here very clearly 3 asset bubbles created by central banks, starting with the tech bubble. Oops, sorry. The tech bubble, as soon as the tech bubble came down and the line began to get close to the GDP line, we had another expansion, the housing bubble, and today, this is where we are. One simple way of understanding the mechanism by which credit affects asset prices is by looking at the price of credit, which is interest rates. Plentiful credit is reflected in low interest rates and hence in low discount rates for discounting future cash flows. Every first-year finance student knows that the discount rate is used to value the terminal value of an asset in a DCF model. As rates fall, asset values appreciate along this line, and vice versa. As rates approach zero, asset prices escalate asymptotically. In other words, they explode. Of course, this is exactly what Ben Bernanke et al. Had expected and wanted, so it's not surprising that this order of magnitude excessive asset appreciation develops as rates approach zero or go through the zero bound. At Eschaton, we've sought out shorts of the most excessive valuations as low-risk, high-return shorts. Near the top of the list is the European bond market. Bond markets in general are overpriced, but we think the European market is crazy overpriced, thanks to Mr. Whatever It Takes, Draghi. We have the central bank has been buying up sovereign debt, corporate debt, junk debt, such that interest rates in Europe make no sense. And I would remind you, this policy is about to end at the end of the year. These are the highest bond prices in the history of Europe. Another set of bubbles that we find interesting are property bubbles. There's some in Scandinavia, but as I showed in the earlier credit cycle with Canada and Australia, we think the most shortable and most interesting credit bubbles in the property markets are in Canada and in Australia, particularly Australia. But I want to bring your attention to this. You see here the disposable income to the debt to disposable income line in Canada way surpassed the peak in the U.S. at the peak here a couple of years ago, 10 years ago. This graph is now out of date because this line really is way up here. It's 190% in Canada, and it's the same in Australia. And then I want to draw your attention. I don't know how well you can see this. This house was a listing that I just came up on looking through on the internet, looking through Vancouver housing offerings. I don't know if you can see all this. I looked at the price of $4.4 million, and I thought, well, maybe the house is very long. Maybe goes back way back in the property, but it's 2,000 square feet and 2 bedrooms. So we think the Vancouver, Toronto, Melbourne, Sydney, these markets have massive credit bubbles, and the banks that are financing them are some of our shorts. And of course, U.S. stocks, another bubble, most expensive in the world. Hard to believe we're back to where we were at the peak of the tech bubble, higher than ever before, higher than any other time in the 20s or anything else. U.S. stocks are very expensive. Both ETFs and tech stocks are very expensive. And here's one of the reasons why. To again, look at this margin debt relative to the other bubbles we've had, and it's off the charts. We think a lot of this is retail borrowing against ETFs. But not to be outdone, much larger amounts of debt have been borrowed to companies to buy back their own stock. We think this is another clear example of an order of magnitude excess of money printing, which has affected the stock market profoundly. Now I want to pause here for a minute and make a separate point. I want to acknowledge the possibility that some of this asset appreciation is actually a function of profound technological changes wrought by the internet and other disruptive advances, rather than central bank largesse. We've thought about this and the possibility that the world at which we call excess is really, in some cases, a justifiable repricing of vast changes that we neither foresaw, and sadly, we did not invest in them, so we didn't profit from them. But Eschaton is not short these exceptional internet companies because we think they're really good businesses and they may well be worth their current prices. Facebook subscribers. All right, but here's another point that I think is really important this morning. This is the same graph you saw earlier, but what we're finding is that this asset appreciation is spotty. It's not universal. For example, if zero interest discount rates actually functioned to affect all asset prices, Japan and continental Europe should be the most expensive stock markets in the world, but they're not. More on this in a minute. Even in the Anglo-Saxon markets, we observe some asset valuations are even near the cheapness extreme. How do we explain this domestic financial non sequitur? Now, I want to admit this is puzzling to us, but perhaps Stan Druckenmiller has hit upon an explanation when he recently expressed frustration of trying to invest in capital markets where discount rates are non-existent. In such an environment, the application of rational valuation metrics to businesses would be extraneous. By the way, Druckenmiller also observes that the equity price discovery is not functioning if stocks don't react rationally to news. Maybe Steve Bregman will talk a little bit about that as well. This, too, is consistent with our experience that fundamentals do not seem to matter very much. In a rudderless context without discount rates, perhaps momentum is the path of least resistance. Such a momentum market is, of course, toxic to contrarian investors, but theoretically, this investment style should correct in the developing new reality of higher interest rates. As mentioned above, foreign markets, that fact of zero to negative interest rates are not inflating stock prices, means that the mechanism by which the interest rate versus the cost of equity capital arbitrage is not functioning. Our years of experience in these venues has taught us that capital arbitrage is not a widely practiced as legitimate business activity in some countries. So, for example, we're not holding our breath waiting for the next Japanese or German Henry Singleton. To illustrate, consider Japan. The Bank of Japan's order of magnitude stimulus is certainly pushed up stock prices because they are buying up about half of all the equity ETFs. But on the corporate level, although we've heard that Japanese managements are changing their capital allocation behavior for decades, huge capital arbitrage opportunities remain unexploited. For example, despite the rise of the Nikkei index, fully 40% of all publicly traded stocks in Japan today are trading below tangible book value. And half of all the public companies in Japan have net cash on their balance sheet. This is in a market with negative interest rates. Or look at Europe. When in Germany a few weeks back, I asked managements why Germans didn't take advantage of the ridiculously low junk bond yields and negative short-term rates to mimic their American counterparts by aggressively buying back shares, funded by virtually interest-free debt. We don't do that here, was the answer, echoing the contempt that continental Europeans demonstrate for what they call financial engineering. Now, of course, financial engineering has been the principal financial activity of North American public companies for years. So capital arbitrage certainly does work here. What seems not to matter so much here these days is profitability. Did you realize, for example, that 40% of the Russell 2000 is losing money these days? In this year's swarm of tech IPOs, profitability are virtually non-existent. To quote a Wall Street Journal article from last month, this year's tech IPOs have priced an average of 9% above their proposed ranges, according to DealLogic, even after the average tech company has soared 28% on the first day of trading. In another sign of exuberance, investors are overlooking lofty valuations and measly or zero profits to have a shot at outsized return. In the first 3 quarters of this year, 4/5 of all U.S. listed IPOs were companies that had lost money in the prior 12 months. This is the biggest proportion on record. Steve Rawl is going to talk more about this in his speech. All right, let's look at the long side of Equinox's portfolio of misvalued assets, confirming my contention that today's monetary largesse has made valuation irrelevant. Look at the profitable resource companies in America or North America. There's no evidence that zero interest rates are being factored into those valuations. This is the oil and gas index as a percentage of S&P 500. It's the lowest level almost ever. One of my friends and one of the most thoughtful analysts in Calgary is named Kurt Molnar, and I recently sent him an email and asked him a question. I said, what is the implied discount rate on these stock prices of the companies that you cover in Canada? Now, Canada is even more out of favor than U.S. energy companies. And you see from his answer, if you're not expecting much lower commodity prices, and we are not, then it's safe to say the discount rates are the highest I have ever seen in my career in the broad sense, which is another way of saying the stocks are the cheapest they have ever been, ever. Now, to sharpen the question, why don't investors in a zero interest rate, very low interest rate environment invest in businesses that have the highest implied discount rate in Kurt Molnar's career? This behavior makes no sense financially. Value investing isn't working when such low valuations, or in other words, high discount rates, coexist within a financial context with order of magnitude excessively low discount rates. Go figure. We can make a similar point about other cheap stocks in our portfolio. Such huge market anomalies can only exist in a world where valuation is at least irrelevant. These examples defy logic of finance and therefore are nonsensical, but they exist. We submit that our longs might well perform well, even in an environment of tightening credit, because rational valuation comes back into investment use. This is very much parallels our experience in 2000 when some of our stocks, tobacco stocks, tripled in a period of rising interest rates. With that in mind, I've recently decided to go back and review the letters that we wrote at Equinox Partners during the dot-com bubble. And the similarities with today are spooky. Like this year, market breadth narrowed dramatically in just the tech stocks near the end. 20 years ago, the Russell 2000 declined 2%, but the NDX 100 rose 85% in 1 year, and the 6 largest stocks went up 120%. And the same thing happened again the year after. Priceline.com, with sales of $75 million, went public at $2 billion market cap. A month later, it was valued at $23 billion. And when a Merrill Lynch analyst recommended it, it went to $30 billion. Most of you are old enough to remember the deification of California venture capitalists in those days and Alan Greenspan's fretting about Y2K. You probably don't remember Fed Vice Chairman Alice Rivlin, who stated in May of 1999, 2 months before she left the Fed, quote, I don't see us as overall in circumstances that might be characterized as frothy or as a bubble economy or anything like that. Rivlin resigned in July. Does this remind you of anyone else? Of course, there are important differences. Central bank stimulus today is at least an order of magnitude greater, and it is global. The manic price extremes of the 20 years ago were higher, but they were more concentrated in just a few, mostly U.S. tech stocks. Today, I would say the bubble is not absolutely extreme, but it's much wider in scale and scope and manifest in much broader set of assets, especially global bonds, property markets, and U.S. equity ETFs and tech stocks. But the similarities, I think, are instructive. 20 years ago, despite losing money for 6 out of 7 years, we recognized the opportunity such behavior was creating for value investors. In our Equinox letter of early 1999, we wrote, and I quote, "The hugely anomalous valuations present on both sides of the portfolio are generating a once-in-a-lifetime opportunity for investors, but one which almost no one will seize." Both statements were prescient. Equinox raised exactly 0 amount of new capital. And in the ensuing decade, with the renaissance of valuation as an investment criteria, Equinox portfolio went up 16 times, and the S&P was flat. In conclusion, it's our contention that a decade long of simultaneous market indifference to valuation and order of magnitude excess of global money printing is not a coincidence. We believe they are causally linked through a long episode of Druckenmiller's zero discount rates. But the times are changing. Such excesses now in reversal, as even central bankers recognize the bad effects of hugely excessive stimulation, such as the massive misallocation of capital at zero interest rate discount rates. As a result, we submit that this long-running era of excess has started to revert, maybe back all the way back to one of some moderation and temperance. Remember Ben Graham's quote, "In the short run, markets are voting machines. In the long run, it's a weighing machine." In other words, proportionality and balance will prevail over time. We think the time has finally arrived. So with that, I think I'll just show you a brief snapshot of our portfolio and the attribution. As you can see, we have, I think that's 10 different themes. We can come back to this later and talk more about it in more detail. But you can see none of these are making us any really serious amount of money. The worst are resource companies, precious metals, and oil and gas, but nothing in Eschaton is working. So on that happy note, let me stop and open the floor to questions. Left them speechless. Well, the central banks have been the major purchaser of all these bonds, and so the interest rates, they've pushed interest rates to zero. When you say they're held, I'm not sure what you mean by where they're held.
Well, it just means that banks were able to facilitate this versus private institutions, Wall Street versus central banks.
Well, take Australia, and we'll be happy to spend all afternoon talking about Australia and the Australian banks, because they are the ones that facilitated the property bubble in Australia, which is epic in proportion. The answer to this is true of a lot of property bubbles, but I think Goldman Sachs is responsible for the margin debt. I'm sure that it's all your firm's singular effort to inflate the U.S. stock market with margin debt. Other questions? Yeah. Short the precious metals? It's a negative return. Yeah. So am I. I wish we had been short them. No, these are the returns.
You said all 10 are not working, but the first 3 are up.
I'm sorry? Yeah, so we make 1% on emerging markets. I don't consider that working.
Talk a little bit about Eschaton's view on inflation versus deflation going forward.
Oh, Stephen, that's a long question. Yeah, we see a lot of inflationary forces in the pipeline, in particular in the labor markets around the world. They haven't been this tight in a long time, and I have to tell you, from what I'm seeing in the anecdotally, labor markets are as tight as they were in the 1970s. Now, what this all means and how all this comes through, I'm not sure, but we think there are serious inflationary forces that will have yet to really manifest themselves. And then we also are developing finally, we're developing a bit of a bullish outlook on energy as an overall theme. This is not why we own energy stocks. We own them because of the businesses themselves. And so those two forces, we think, may put some pressure on prices going forward that are not yet understood or appreciated in the market. Yeah.
I just want to follow up on returns then. And so, to my eyes, you're crushing it on emerging markets relative to a benchmark.
Okay. Well, we don't measure anything relative to benchmarks.
But it pertains to your security selection.
Okay. Yes. Well, thank you very much.
In contrast, energy does not appear to be.
I don't. Have you looked at the Canadian Energy Index?
So it's all Canadian.
It's not all, but too much of it is in Canada, and that's been a big problem. We might talk a little bit about the pipeline issues in Canada. So this is an area of the stock market that's hated as much as anything I've seen in a long, long time as in general. But Canada is even worse. And we talked to the management and some of the analysts up there. They can't even get meetings. One of the best energy companies in Canada wants to go to Toronto to talk about their company to their institutions, and they can't get time to talk to them because they want to talk about cannabis stocks. So the energy area in general is hated, and it's unusual. It's surprising. No one I know can really explain it, particularly in Canada. Anders.
How are you shorting European high yield?
We're shorting all kind of things. We're shorting bonds of all. It's not even so much high yield. And we looked at high yield. We'd rather short high yield, but the duration of those bonds is generally too short. So we've chosen sovereigns and other ways of implementing this. It's a big part of our portfolio, but not much in high yield. Yeah.
You've obviously been earlier in your call with precious metals and your company there.
Yes.
What do you think it will take for precious metals to finally?
We've been waiting all week for this question, and I'm going to turn that over to Steve. But the short answer is we've been waiting for a long time for precious metals to work, and you all are probably aware that for the first time in a long time, a commitment of traders showing that both gold and silver is in a net short position, or it was a week ago, which hasn't happened since the tech bubble. But I think depending on what central banks do in response to various declines in asset prices, maybe that's the time where precious metals will increase. It's not a huge piece of our portfolio, and we might increase it or increase the leverage of it as time progresses. But certainly, it's yet another really out of favor, unpopular part of the portfolio. Okay. According to option trader Chris Cole, active investors have been replaced by passive index funds. Systematic trading, active investors have been replaced, as I said, in factor-based quantitative investments. Today, fundamental discretionary traders account for only 10% of trading volume in stocks, according to JP Morgan, while rules-based strategy account for 60%. Today, we're delighted to have Steve Bregman here to discuss indexing, one of the main culprits in the demise of price discovery. We have witnessed firsthand the effect of large capital flows from active managers making valuation judgments to price-insensitive machine-driven strategies in an environment where fundamentals like valuation just don't matter. As many of you know, over long term, we have ended up with smaller, less liquid stocks because we found that the valuation Anomalies are greater in less liquid stocks and smaller stocks, and that certainly hurt our performance. Again, Chris Cole, this will be the last time I quote Chris, passive investing is just a crowded liquidity momentum trade and is outperforming compared to active managers by self-fulfilling. When a market is dominated by passive players, prices are driven by flows rather than fundamentals, and liquidity is the determinant, the sole determinant of value as defined by a constant bid and offer price. When market participants gain confidence in quantitative investment factors, it becomes real, regardless of whether it makes sense. So to try to help us make sense of all this, I'd like to introduce Steve Bregman.
Thank you, Bill. Bill, I should thank you in particular because people like you, investors like you, and your professional background, Rain Kniff and so forth, that was what I aspired to when I was paying my dues at a private bank in my 20s. So I feel elevated to be here.
I'm honored to be here. Thank you.
So this goes. Yeah, okay. This presentation was originally made for the 2016 Grants Interest Rate Observer Conference, at which Bill saw me, but it's aging a bit because life doesn't stop. There are important observations to make that could not have been said 2 years ago. But there's only so much I can fit into 45 minutes, so some historical background has been dropped, and some of the colorful examples of index distortions have been dropped in favor of new developments. But I'll start off the same way, and I'll try to speak fast, which is not my ordinary capability. I'll start off by using the B word. We're in the midst of a bubble that is not only greater than I've seen in my career, but the greatest ever. And that strikes many as outlandish with volatility so low, notwithstanding the past month, with PE ratios that don't seem inordinately high in the context of low interest rates. At least that's what the statistical models say. But I would suggest that the models themselves and the unprecedented low volatility are part of and symptomatic of the bubble. I hope to show why in the entirety of the S&P 500 there might no longer be more than several value stocks, if that, and why the high yield index cannot possibly deliver even the non-high yield 6.5% return it advertises, and why those of you in this audience who might possibly own ETFs or index funds likely don't even know what your own exposures are to growth stocks or value stocks or international allocations, or even what your risk volatility statistics really are. A perceptual challenge is that there is no great pinnacle evaluation, such as during the internet technology bubble of 1999. I'd liken that one, because we work on prior memory, to seeing a water spout at sea. It's noticeable, you can look up and say ooh and ah, but it's remarkable in its way, but there's not that much energy in it. It's mostly wind and mist. And the tech bubble did not engulf the entire market. Today's bubble, though, I would say is more akin to the entire sea level rising by 2 or 3 feet, as in a tsunami wave rolling slowly under you, far from shore. You might not even notice it, not very volatile, but the energy it contains is enormous. The process by which we came here is important because it's sequence dependent. An action in the marketplace doesn't take place in isolation. It's noticed, it's responded to, it creates some flow of excess demand. That demand gets gamed for business purposes. The public is eventually brought in wholesale, and so on. So understanding how the process has manifested itself informs how to avoid the inevitable damage. I'll provide just a handful of the endless examples of distortions caused by formulaic basket-based investing, how it's been blindly moving trillions of dollars in very particular directions, and how it has created a bifurcated market, which has been on Bill's mind and mine like no other in history. I'll call it the ETF divide between those companies selected for ETF inclusion, and those rejected by the ETF rule set, and how this mechanistic approach has been not merely distorting valuations, but a far greater consequence, disrupting the price discovery mechanism. First, though, to whet the appetite, a test. And this is a valuation sobriety test. And I'll use the bond market. You can argue stock valuations until you're blue in the face, just too many variables and suppositions and points of view, not so much room for debate on bond prices. As a frame of reference, benchmark, 10-year U.S. Treasury yields 3.1% or so, give or take. Is it reasonable for the extra credit risk that a 10-year A2 rated corporate like JP Morgan Chase trades at a 4.3% yield at maturity? Reasonable minds would probably concur that the extra percentage point is sound. And would another 40 basis points for a somewhat lower but nevertheless investment grade credit like Citigroup be reasonable? And by extension, how about another 1.5 percentage points, a 6.2% yield for a 10-year note of a single B company, but one with a huge equity market value cushion like Netflix? Why not? Maybe. So the sobriety test will consist of some holdings of the iShares, I'll slow this down so you can get your minds around it, of the iShares Emerging Markets High Yield Bond ETF, ticker EMHY. Okay, and the question for each bond I'll show you is what price for the extra risk? As another benchmark, the average weighted yield to maturity of the U.S. High Yield Corporate Bond Index is 6.6%. Okay? So first up, Russian Federation bonds. The country's sovereign debt is not investment grade. You all know enough about Russia, I suppose, to make your own judgments about sovereign risk. Russian credits, by the way, are one of the largest in this ETF at about a 7% weighting. So if you know the answer, you can't raise your hand, but anybody hazard a guess as to the yield on these bonds? There's no wrong answer. Anyone? You're among friends. Now I'll save it for later. Next, we have an 11-year note of Azerbaijan's state-owned oil company, also not investment grade. For your information, to make an informed judgment, understand that Azerbaijan is smaller than Maine. It's about 100 miles on a side. It's sandwiched between Russia, Turkey, Armenia, with which it has not yet resolved generations-old territory disputes, and Iran. Okay? Yield, anybody? No? We'll save it. This ETF, by the way, is one of your bogeys if you're a bond manager. Although it's down year to date, like most bond funds, it returned 14% in 2016, and it was up 9% in 2017. So, what are the yields of these bonds, I ask you? So, 5.0% for the Russian, see, you should try to guess. So that's only about 50 basis points higher than JP Morgan and Citigroup bonds. And really, how does Azerbaijan, state oil company, or Banco de Bogota, Colombia, borrow more cheaply than Netflix and marginally more than Citigroup? And there are way more colorful examples, by the way, than these in this ETF. And EMHY, this ETF, trades only about 70 basis points more than the U.S. high-yield corporate bond ETF. So, as a mental experiment, would anyone seriously argue that these yields are adequate compensation for the risk? If you buy them through the ETF at this price, necessarily, what if the ETF disbanded and had to pay you out in kind? Do you think you could sell these bonds at these prices in the open market privately? Think not? Then do the prices result from some other factor? So by regulation, when new money comes into EMHY, the allocations must be done promptly and according to the precise index weights. In this context, see, the external debt of the entirety of Azerbaijan, its supply of bonds, is all of $17 billion. Now, just Johnson & Johnson alone has $17 billion of cash in the balance sheet. We need not talk about Microsoft's $100 billion plus. So the point is there's not much of these credits to go around relative to the scale of global institutional money allocated to this sector. So think of it as an automatic bid for the bonds in this ETF. And there's no factor in the algorithm for valuation. It just doesn't exist. There's no analyst at the ETF organizer or at the pension fund that might be investing who's concerned about valuation. It's not in the job description. Okay, there really is no price discovery. And if there's no price discovery, is there really a market? So in which case, if you own EMHY, what is it really worth? So this is all about artificial supply and demand pressures. And you can take this exercise and apply it to the equity indexes. That's what's going on. It's just tougher to debate. Okay? So let's go to get the broad equity market valuation issue out of the way. I probably don't even need to do this. Bill pretty much covered it. I like to look as a clarifying look at the stock market's trailing 5-year average PE. You've seen this kind of thing before. It smooths out all the rough spots, special gains, tax law changes. So at 27 odd times earnings now, in the last 130 years, it's been higher only twice, which was the internet bubble year in 99 and in 1937, not because prices were high, but because earnings disappeared. I think that's the second best measure. I can see this audience, you know these charts. The best, in my opinion, is this one. You don't even need analyst earnings estimates. It's just the market value of all stocks in the U.S. It's easy enough to get. Go to a Wilshire 5000 fact sheet. Compare that to U.S. GDP, which in essence, you're comparing the market value of stocks to the productive capacity of the U.S. in some fashion. And that is now 1.5 times. And it's the highest level that's been reached in the last 70 years, for which we have data other than, again, the tech bubble peak. You need a 50% market drop just to get back to average. So now some history, because none of this happens in a vacuum. You already saw one chart about this. You must look at the long-term march toward indexation, because as a concept, it's entirely sensible. But there is this pesky issue of supply and demand, which I'll get to momentarily. The inflection point for indexation, which was almost a negligible portion of the market at the time of the credit crisis of 2007. It was at that moment that pretty much every level of market participant wanted away from volatility. They wanted away from security-specific risk, from sector-specific risk, away from it all, and it lent an urgency to the indexation movement. At its simplest utility, instead of buying your favorite REIT, maybe that's the one that goes to zero, you could buy a REIT index. It might not do well, but at least you know it won't go to zero. So money began pouring out of actively managed equities and into index instruments without a single annual exception, even during the crisis and post-crisis years when there was a net outflow from equities in the U.S. And it's been about $1.7 trillion out of actively managed equity mutual funds, $1.4 trillion into index instruments. So that's a $3 trillion swing. That is a lot of supply and demand change. But ETFs are the key, not index funds as a class. So indexation is originally proposed by the academic founding fathers, people like Harry Markowitz and Paul Samuelson and Fisher Black, and is originally practiced by Vanguard's Jack Bogle, envisioned owning the entire market. You make a long-term asset allocation decision with very little adjustment. So why then does the SPDR S&P 500 ETF, based on recent daily volume, have annual turnover of 2,300%? That's 100% every 2 weeks. That's a lot of asset allocation. So what's happening now is a very different animal than what indexation was supposed to be. Why has this happened? One of the great effects of the financial crisis was the acceleration of indexation as a business, not merely a tool to measure performance. So we're into incentive systems now, the business end of promoting ETFs. Okay? So the ETFs were set to be a comfortable oligopoly. They were a better mousetrap, and the original ETFs had, say, 85 basis point fees compared to mutual funds, which might have been 120 basis points. And it might have worked, but it couldn't because of the confounding influence of Vanguard, which, as you might know, is a non-for-profit institution. It's owned by the fund holders. So what Vanguard does is every time it gets more AUM and greater scale and its unit cost decline, is it lowers its fees. So Vanguard made fees compress for the mainstream index funds, and the ETF companies, even robo-advisors, can't earn a living at 5 basis points. Okay, they couldn't compete head-to-head with Vanguard and the plain vanillas like S&P 500 or Russell 2000. If you think about a $100 million ETF, even at 20 basis points, that's $200,000 in fees before a single penny of salary or other operating expenses, of which there are plenty, are consumed. So it just doesn't fly. So, because it's a low-fee business, it must be done in scale. And the limiting factor to scalability is the trading liquidity, if you think about it, of the least liquid members of your index. So you can't afford to be held back in your ability to accept more assets by companies that simply don't have the market cap or trading volume. So you can't hold you can't build a $1 billion ETF if some less liquid company with an X% assigned weighting just doesn't trade enough to let you buy that percentage. So what the ETF organizers began to do is to change their security selection rules to ensure sufficient scalability. And that so they began to exclude less liquid companies to reduce their weightings, those with a lot of inside ownership, because they had less float. So thus began the era of industrial scale investing with the necessary focus on large and mega cap companies, and it's a pretty limited population. So business being business, how do you deal with a commoditizing product? Product differentiation. It's been done before for vodka and cigarettes and shampoo. Ergo, if you ever wondered why, the proliferation of all these subsets of the market for which a higher fee could be charged. Country funds, sector funds, style funds, and so forth. So let's see now some different classifications of ETFs, what they say they are versus what they really are. Okay? We'll start with the foundational principle of indexation, which is diversification of security-specific risk. But with time, a market capitalization weighted index, which is how these are constructed, with the largest companies getting the largest weights, becomes top-heavy, get concentrated. Investors in the iShares U.S. Energy ETF presume to be buying a diversified portfolio. They fled idiosyncratic risk. Do they know that just about 50% of the fund is in just 4 companies? That they've actually fled right back to buying idiosyncratic risk? What happened to British Petroleum not so many years ago in the Gulf of Mexico could happen to Exxon. And it did. It was called the Exxon Valdez disaster. Okay? I'll call that semantic investing. It's got nothing to do with financial analysis. There's also an example on this slide of industrial scale and semantic misinvesting internationally. So let's say you had done some business in Spain once upon a time and you had a feel for it. You felt that the decline in local stocks was overdone and there was some resilience in the economy. So you bought yourself a Spain ETF because you just wanted a diversified exposure to the local economy. Would you have known that the 10 largest positions in the $1 billion Spain ETF, iShares Spain ETF, account for 70% of the fund? More important, would you have known that 7 of the top 10 holdings get an average 70% of their revenues from outside of Spain? Why? Because the ETF needs large liquid holdings, and there just aren't that many to go around. What they have more properly described are large cap global multinational companies, like Amadeus is in there, which is a global airline reservation system. More important, do the pension advisors know that? Do the asset allocation programs they use incorporate that? Do the robo-advisors? So in this context, what does country allocation even measure? The same goes for emerging markets. You don't get exposure to the truly dynamic local companies that represent local growth. You get exposure to the large cap export-based companies whose growth is dependent upon developed markets. Okay? Here's an example of, am I in the right place? Yeah. Semantic misinvesting in fixed income. So this is one of the largest, 10 largest bond ETFs in the country. It's a major asset allocation building block with 14 billion of AUM. It's the iShares High Yield Corporate Bond ETF. Average yield to maturity is 6.6%. The yield to worst is lower. The SEC yield is 6.1%. First of all, you will never get the 6.6%. So that presumes there will be 0 defaults. There are always defaults. As advertised, 99% of the holdings are below a BBB credit rating. 11% are CCC and below. So if there are absolutely no defaults among the various B classes of bonds, which is not a depiction of reality, and if only 1/3 of the C classes of bonds lose 1/3 of their value, sake of argument, then the fund's yield to maturity would be reduced to 5.4%. And the starting yield of 6.1% is not even real. Almost 3% of the bonds in the ETF have by market value, have an average 22% yield. The fund will not get a 22% yield out of these, since that's the rate paid on bonds until they default. So it's just temporary. So they enhance the yield to maturity by about 60 basis points. Now you're down to about a 4.8% return. without any defaults in the B classes of bonds. Anyway, you take away taxes, and you're very close to a negative real return after inflation. So it's not high yield, it's just low quality. Now here's a more granular demonstration of the clearing price distortion created by the demand of ETF organizers for the limited population of large cap liquid stocks. It's a necessity for them, a business necessity. So say that in 2013, on a bench in a train station, you came upon a page torn from an ExxonMobil 2018 financial statement that a time traveler had left there inadvertently, violated protocol. So there it is before you, on paper, detailed factual information of Exxon's results 5 years in the future. You'd know everything except, like a morality fable, the stock price. Oil prices down 25%, revenue down 40%, earnings down 64%, the dividend payout ratio ballooning from 22% to almost 90% of earnings. If you shorted, you would have lost quite a bit of money after your cost of carry because the stock price didn't budge. Now, because the financial statement didn't mention the era of industrial scale investing, which requires highly liquid shares, and Exxon is about the most liquid. Ergo, as raw material for any ETF that requires scale and can tinker with its rule set to include it, it will be found. Aside from being 25% of the iShares Energy ETF and the like, Exxon is simultaneously a dividend growth stock and a deep value stock. It's a USA Quality Factor ETF and the Tail Hedge ETF. It's a momentum tilt and a low beta stock. Sounds like a vaudeville act. Okay? It's in 246 different ETFs. It was only in 206 last year at this time. So essentially, the company stock has been denatured, commoditized. It no longer reflects the changing value of its business, but rather the demand for its shares by index funds. And that phenomenon could be seen in almost any of the largest S&P constituents. Money has been structurally channeled into the most liquid securities anywhere in the world where ETF money has been directed in size. Okay? It applies to global diversification. Unless you think that the ExxonMobil example is specific to the cyclicality of the oil market, look at McDonald's. Okay? Let's give the company a running start. What was sales growth from the 2008 crisis year, the recessionary period, all the way to 2017, a full decade? If you ask people, if I did the guessing game with you, they'd say, I don't know, 3, 4, 5%. It was negative 3% a year. Its debt is up 190%. Share price is up 175%. PE ratio expanded by 50%. Same story with the other blue chips like Procter & Gamble and Coca-Cola. It's not their fault. They've reached the per capita limit of how much soda and disposable diapers and mayonnaise they can sell. Not so long ago, though, valuations would have contracted as growth slowed. Investors voted with their feet. But McDonald's, for the sake of argument, is bought now as part of a basket. Since investors didn't buy the shares individually, they can't sell them individually. So where's the price discovery? Now, a common view of these companies at 25 times earnings is that low interest rates justify the high valuations. That's been true historically, but it's also true that historically these are growth companies, which they're not anymore. Now, how about the risk measures they provide you in every index fact sheet? In the financial realm, risk has come to be measured by historical price volatility. The most prominent statistic for risk is beta. I know it because if you go to Yahoo Finance and type in IBM, their front and center alongside market cap and dividend yield is beta. All that beta does is measure the daily price behavior of a security relative to the S&P 500 over, say, 3 years. So the S&P 500, by definition, is given a beta of 1.00. You got a beta of 1.2. It says it's 20% more volatile than the S&P 500. A beta of 0.8 says it's been 20% less volatile. So some fun with beta. As described, collapsing fees necessitated the creation of more exotic ETFs that could charge higher fees. But there's an impediment. It's almost impossible to launch a new fund that doesn't backtest well. And backtesting well includes a low beta. So I'm going to read you a couple of low beta ETFs. The iShares Qatar ETF, tiny Qatar, sandwiched between Saudi Arabia and Iran, a beta of 0.74, 25% less volatile, less risky, they call it, less risky than the S&P 500, you should own some. You should own a lot. I like this one more. iShares Frontier 100. If you're not familiar with this, this is the emerging markets of the emerging markets. Okay? Among its more interesting top 10, but by no means the most interesting, is Nigeria, home of Boko Haram. Okay? Beta 0.52. So is it weird that an emerging markets index is 50% lower risk than the S&P 500? How do they do that? So that column on the right, what is this column? So one way is the automatic bid, if you remember the Kazakhstan bonds. But also the beta is not necessarily measuring emerging markets. Here's the weighting of each of those two ETFs that I just mentioned in financials. 52% and 44%. So that column is financials. So maybe you're not selecting for emerging markets, maybe you're getting exposure to the financial sector. So nevertheless, these portfolios can be characterized as low risk because the financial sector has not been volatile, which assists the ETF in attaining its advertised low beta. But certainly we know that low volatility is not an inherent trait of the financial sector. I dare say no one would assert that these ETFs will remain non-volatile if interest rates rise. But by the time the beta is over 1, it will be far too late. A last couple of examples. We can see here how the use of historical statistics actually distorts the risk analysis problem, at least when they're being employed for the purpose of asset gathering and ETF creation, as opposed to investing. Last couple of examples of how the rubber band is being stretched. Are we all aware that the Swiss National Bank is buying the US bond market? So according to its 13F filing, it holds $85 billion of US equities. That would be the 5th largest ETF in the US if it were an ETF. So now we have a foreign bank intervening in our markets, and it's buying blind. It's buying the same largest, most liquid stocks. So it owns over 2,500 stocks. If they were an ETF, they would say we give you coverage of 99% of the US market by value. But the top 10%, 250, account for over 3/4 of the market value. That's how concentrated it is. It's all the same flow. So irrespective of motive, an equity portfolio manager such as Bill Strong here is no longer competing in the market auction process with other buyers with limited capital. A government buyer is not motivated by the ordinary considerations of fair value. So can one say there's any price discovery? But the very premise of indexation is that security prices reflect fair value. And you'll see much the same in the largest 5 growth stocks at the top of every major index. We know which ones those are. Those 5 account for $4 trillion of market value. Rounded, it was 4.1 a week ago. In the S&P 500, if you start from the bottom up instead, you need 284 names to equal the same $4 trillion. In the Russell 3000, you need 2,329 names from the bottom up to equal the same 4 trillion. So are you really getting exposure to the nether regions of the Russell 3000, which presumably is why people buy that? So the idea of being diversified is a way of achieving safety, but if the indexes are market capitalization weighted, that guarantees that the systemically important companies are going to be in everybody's portfolio who indexes. And people who fled from risk, they're right back to as great a risk, perhaps greater. So in broad brushstrokes, this covers some of the high points of the ETF waterfront while I'm not through yet. I don't know, when do you think I'm through? There are plenty of ways to buy a reasonable bond or earnings yield, but the mainstream instruments clearly cannot be that place. They're priced to reflect their utility as liquid trading instruments. Okay? So now for the start of what's beneath the ETF divide. I'm going to read you some names, and this is just an efficient way to capture a different picture of market distortion. So Bill even referred to this. In the past 4 years, the most outstanding mutual fund and holding company managers of the past couple of decades, each with different styles, collectively and simultaneously underperformed the S&P 500, and we're talking 10 to 20 percentage points in a given year. There's no precedent for this. It's never happened before. I came up with 9 of them. There are more, I'm sure. Gabelli Fund, Fairhome, Wintergreen, Longleaf, Icon Enterprises, Greenlight Reinsurance, Royce, Microcap Fund. Just a couple of examples from 2014 through 2017 in order. Gabelli Fund underperformed by 12 percentage points, 11 percentage points, a fraction of a point, then 1.3 percentage points. They're all like this. Fascinating, huh? So what is the statistical likelihood that this highly divergent set of portfolios with very little overlap could all underperform the market in not 1 or 2, but even 3 or 4 years in succession, and by that much? Is it possible all these people lost their touch together? They all got stupid at the same time? Either they're the anomaly or they're not. And if they're not, maybe the market is the anomaly for outperforming. And if that sounds like a somewhat extreme suggestion, consider that. In 2015, the S&P 500 was up 1.25%, 1.5%, but absent just 10 names, it was down 2%. In 2016, just about 40% of the market's 12% return came from just 15 names out of the 500, much the same last year. And of course, among those names, Google, Microsoft, Netflix, Facebook, Amazon. So part of the answer we know. On a simplistic basis, the reason that Mario Gabelli, despite suffering outflows every quarter, is he simply refuses to alter his methods. He's simply not going to buy a retailer like Under Armour at 70 times estimated earnings, or a retailer like Amazon at 90 times, or a content reseller like Netflix at 120 times. So he underperforms. It's just the way it's going to be. An active manager can be dismissed. I'm dismissed all the time. An active manager can be dismissed for underperformance relative to the benchmark. But if the passive investors get poor performance, or their ETFs behave dysfunctionally, they can't, by definition, complain of underperformance, since the indexes are the benchmark. That is the return. That's the return you're supposed to get. That's what they tell you. So what makes it stop? Okay, why won't the money keep coming in and just keep this up? People ask that. There are a number of reasons. I'll go through them. Net inflows. Okay? The ETF-centric companies depend on continued net inflows for that automatic bid I described to support the valuations. Recalling that multicolored area chart of the $1.4 trillion of ETF inflows, that shows that they've been funded pretty much dollar for dollar by outflows from the bank, if you will, of active management, of which there's a finite amount, and that can be measured. Okay? At the current rate of ETF inflows, it won't be that many years before the bank of actively managed assets is depleted. But it won't even get that far. First of all, because not every investor will leave a Mario Gabelli or a Bill Strong or, heaven forfend, a Stephen Bregman. Okay? So active management won't get anywhere close to zero. Moreover, flows don't just stop on a dime. They first begin to slow. And when net inflows begin to stop or seesaw back and forth, it's at that moment that the baton will pass from the index buyer, which has been the marginal trade in the past 10 years, to the active manager. And then things will become interesting. What I can't go into here is this business of float, because the real supply of stocks is a lot lower than people think it is. Failure to deliver. There's the matter of performance. So here's a mind-blowing fact that you don't hear much about. Many ETFs now have a 20-year track record, and a whole bunch more are closing in on it. That has now been written into the historical record, and history speaks for itself. Okay? So if we have these dozens of ETFs in the two-decade club, including individual country funds and even the major equity allocation building blocks, we've got the S&P 500, the Russell 2000 index of smaller companies, the NASDAQ 100 tech stocks, some factor-based ETFs like S&P 500 growth and value subsets, EFA, and also the major emerging markets index. Not a single one produced as much as a 10% annualized return. Only 4 of them beat a long-term treasury, and the returns more or less cluster around 6%. Ask somebody on the street who's an investor what they think the 20-year record is, you're not going to get that number. So now there's evidence about the presumed right to a 10% annualized return from stock indexes. Much of this failure has to do with the weighting tactics and rebalancing rules that these indexes employ. These roughly 6% returns from dozens of stock indexes, recall or be mindful that they were achieved with the support of the greatest fiscal and monetary stimulus in the history of civilization, probably, including one of the longest stock market recoveries and one of the longest post-recession economic recoveries. So history is spoken. It just hasn't told the people yet, but it will. What will happen without further stimulus from a variety of important sources. We shall see. Geopolitical risk. President Donald Trump, okay? He intends to reestablish unilateral trade agreements as the new global trade regime, okay, and to thereby reduce the U.S. trade deficit and enhance GDP growth. So the major indexes around the world are dominated by global multinational companies that are essentially dependent upon the existing multilateral agreements model. So that's a common systemic risk that they face, a systemic risk to those indexes. You really don't want to be there. Next, looming technological disruption among the FANG and their ilk. Okay, I like this one a lot. We study this a lot. Technological risk is heading to the biggest names in the market. It's already underway. It's moving with speed. Just to refresh our memories, because we've forgotten already, with what a rush some of the greatest computer technology companies in the world, once household names, disappeared from the face of the earth like dinosaurs. With the advent of one piece of disruptive intellectual property, a piece of software that gained mass market acceptance. So that was Microsoft's MS-DOS operating system for the IBM PC, which was introduced in 1981. And this list here is just a handful of those mainframe and supercomputer and personal computer makers, along with the year they ceased operations. Others that are not on this list simply were acquired by other companies, and those operations ultimately ceased, or they bought their way into other businesses. They ran the alphabet from the A's to the Z's. We remember Commodore and Wang and Unisys. Now a couple of examples, just to give you a flavor for disruptive threats I'm thinking about. So the few firms that dominate the internet business activity, like Facebook, Amazon, and Google, they do so simply because they control the data. The market value of all these companies is based on information asymmetry. So they possess all the electronic data collected from 7 billion people on this planet, and so they own the monetization privilege. It is the intent of a certain person to contain and possibly eliminate this oligopoly of data. And this person is Sir Tim Berners-Lee, one of the founders of the World Wide Web. And his goal is that the data pertaining to an individual will be stored in a separate location on the internet to allow the owner to have complete control over it. The data could not be accessed without proper authentication. And that would include health records and financial data, travel data, internet search, or browsing history. Just 2 months ago, with venture capital backing, he announced plans for a startup to develop protocols for internet usage that would be included in most user software accessing the internet. Now, obviously, if successful, the internet giants would not be able to access individual data. And without that data, including browsing history, there's very little for them to sell to advertisers. And Berners-Lee is not alone. There is a blockchain app. That's a whole other area which is fascinating. But there's a blockchain app with its own cryptocurrency called BitClave. And the idea is to create a search engine, such as Google, and among other things they're doing. And people's searches and associated data would be stored on a blockchain ledger. Advertisers could read the blockchain. They could contact the individual who might be amenable to selling access to that data. And the payments would be made in the form of a BitClave cryptocurrency to each target participant. Google wouldn't be involved. Each person would own their own search history and permit advertising in exchange for an income stream. Or they could just opt out. That is a demonetization and disintermediation of the internet search franchise. And if BitClave is not successful, there are a dozen others trying the same thing. There's another one called Steemit. It's another blockchain app. It's like BitClave, except it's aimed at Facebook. It permits users to monetize social media content. We have it? Yeah. Social media content. But the advertising revenue is paid to the creators of the content, not to Facebook. This past January, it had fewer than 150,000 users. It's approaching 1 million today. Again, if they're not the one, there are others working on it. Shareholders of technology oligopoly companies might consider the following points. A single successful project can disrupt the FANG type stocks. A disruption of this collective business model is enough to create a bear market in the S&P 500. Historically, the S&P 500 was a holistic solution which lent it resilience. So an investor could be indifferent to the market share battle between an Amazon and a Walmart, because the loss of value of a Walmart might accrue to Amazon, okay? Both are in the index. However, these potential disruptors of the data monopolies, they're not in the index. So there's no compensating reward for the loss of value of in-index securities. And that hasn't happened before. Therefore, the investment community is oblivious to it. Okay? The index will be a dangerous environment, and one will only be able to avoid the problem through active management that removes those systemic threats by slanting a portfolio away from firms threatened by disintermediating competition. Does any of this mean that the market will suffer a cataclysm? I'm not sure that it does. In fact, a sudden cataclysm might be an unlikely scenario. Why? It's just a possibility because we don't know how it works. Add up, for instance, all of the small cap stocks in the stock market, those of $2 billion and less, and they come out, combined market cap, to not even 5% of the stock market value. They simply can't accommodate that shift. So where can the money go? Well, it could go to bonds, but people fled bonds because they were starving there. They can't go there. So rather, the money might go nowhere. We can't forget that if collectively some people want to move their money out of the market, they're not even panicked. They just like to reallocate. Okay, let's say it adds up to $1 trillion. We forget the other side of the equation. There has to be a buyer. Someone has to want to buy them, and they have to come up with $1 trillion. So I'm just not sure it could happen. Rather, maybe it's death by 1,000 cuts. First one sector, then another. Maybe the market will go down and recover, be flat, go up again, and eventually, after 20 years or so of pattern spotting and anticipations and disappointments, people will finally realize they've gotten no return out of it. Although that could be just as devastating as a sudden cataclysm. And by the way, there's plenty of historical precedent for zero returns from the stock market over a period of decades. It's another discussion. So accordingly, I would suggest that investing must now take place outside of the indexation sphere of focus. But as you just saw, there's an extremely limited supply in terms of aggregate market value of small cap or non-indexed equities. So redeployment that way can't work for most people, but it can work for a small minority. And in a way, one can no longer afford to be broadly diversified. One needs to be less diversified, I think, so as not to overlap into the same systemic risks. Fewer securities, but with sufficient idiosyncratic features and optionality. They might do well or they might do poorly, but they'll do it on their own recognizance, not because of a change in the Fed rate outlook or the dollar-renminbi relationship. So paradoxically, that's what true diversification must be. The beauty of the markets, though, is that for the tide of money to flow in one direction, it must flow from somewhere or drain from somewhere. And that somewhere else means securities on the other side of the ETF divide. Relatively invisible, not actively evaluated or priced. You can find companies with pristine balance sheets that are highly profitable, that are growing, yet which don't have a single Wall Street earnings estimate. The efficient market has passed them by. The ETF divide has created a massive price umbrella for the active manager. The ground is simply littered with them. One useful search variable here, just to give you one technique for finding them among many. If you're willing to take a bit of illiquidity risk, your degrees of freedom and optionality expand enormously. So here's one technique for locating companies that exhibit purely trading liquidity-based discounts, not because of a management problem, not because of a balance sheet problem. You're actually using, in this way, the ETF industry to help you. So for instance, you can examine all the publicly traded companies in a geographical market that for whatever reason, because there are all sorts of trade-offs when you make indexes, are underrepresented in the global indexes. Norway, for instance, is about a 21 basis point position in the MSCI All Country World Index. It simply won't attract more than 21 basis points of institutional funds. Moreover, there's only room for 5 Norwegian companies. There are a lot more than 5 companies in Norway. You'll find some very interesting names there. You could do the same exercise for an industry that's underrepresented, such as marine shipping, which is by coincidence also a 21 basis point position in that index. You could overlap the two like a Venn diagram and see what you find. We have a number of companies we own that we found that way, that trade at classic Graham and Dodd valuations. Here's one example among many, just one. So Subsea 7's a Norwegian company. It's one of the world's leading engineering services contractors for deep water oil rigs of large oil companies. It basically does everything between that needs to be done between the seabed and the ocean surface. Now, with the collapse of oil prices, revenue's down 37% since 2012. The share price is more than 40% lower. You'd think it has a little trouble. Well, the company has current assets in excess of all liabilities. Its cash exceeds total long-term liabilities. And even in this severe operating environment, it's profitable. It was cash flow positive in every year of this downturn. It's been making strategic acquisitions. It has a renewable energy segment, think offshore wind turbines, which is growing rapidly. It trades at 6.5 times last year's free cash flow. Okay, what does it all mean? It means there's no substantive existential risk. It means, at least the way I look at it, I can hold, in essence, a free permanent call option on a recovery in that sector. I couldn't go to Goldman Sachs, for the sake of argument, and ask to buy that call option. They wouldn't sell it to me, except at a price I wouldn't be willing to buy. A stock like this could easily double or triple. All you have to do is wait. The same applies to income portfolios. It's quite feasible to build an income segment of a portfolio that has an entirely different clearing price than the benchmarks. You find an income security that is excluded from the index rule set. It might lack institutional scale or lot size. It might be the wrong maturity. It might be a non-standard security. So here's one category only of just an example of the diversity available. Is that the right one? Oh, you know, I didn't give you this. Here you go. You can look at that for a second. That's Subsea 7. Anyway, closed-end funds. Closed-end funds are a retail product that you sell them once with a hefty upfront load, like 5%, and it's not thereafter marketed by brokers, although the ongoing portfolios are competently managed. They're not structured for or marketed to institutions. One class of these funds are the MLP funds. They each contain a portfolio of classic pipeline MLPs, such as Energy Transfer Partners or Plains All American. Now, they got to be a bubble several years ago and peaked in 2014. And they now trade at roughly 50% lower than they did 4 years ago. So that makes the funds unpopular. They're also generally produce pass-through K1 income. That makes them exceedingly unpopular with institutions. However, they have dividend yields of just about 10%. Moreover, several of them actually are C Corps. You can find those, so you don't have to get a K1. You can get a 1099. If you bought 2 or 3 of those, since they each have somewhat different holdings and weightings, you could get a well-diversified portfolio of MLPs that fairly represent that sector with utility-like stability. So your return expectation starts at 10%. You'll find that they trade now at about a 10% discount to NAV, so you have that optionality. They've traded at premiums in the past. And they ought to grow by some degree over time, even if it's only 1 or 2%, which confers some degree of purchasing power protection for that income stream, which you can't get in a bond ETF. So that was just one type of non-indexed income security among several. They can't be institutionalized, really, because there's insufficient float to permit tens of billions of dollars to be invested that way. Anyone can do it, just not everyone. And this last one, I wasn't going to show it because this is the last slide. I realize it's more for me than for you, so maybe for you, Bill, too. That's it for me.
Stephen, thank you so much.
Okay.
This is really enlightening. Encouraging. We have a couple of minutes for
Oh.
questions, and the first one that comes to mind is, who owns all these ETFs today? It's not so much institutional. I understand registered investment advisors and retail, and I see your numbers about the turnover rates are shocking. It's just stunning. And then I also see this huge increase in margin debt. And I'm just trying to put 2 and 2 together. Are these owned by
Everybody.
retail on margin? Is this a heavily margined security?
Yes, it's margin. So first of all, at the lowest level, if you're just an average Joe, the kind of Mr. and Mrs. Main Street that John Bogle cares about, and you don't happen to be going to Vanguard, but Vanguard's doing it too. The point is that That is the mode of investing. It's through an index fund. That's the lens through which people see the investment world now. And if you're outside of that focal circumference, you don't exist. It's the mode. Now you get into their institutional investors and proprietary trading desks that do all sorts of fancy stuff in their trading and leveraging, and of course, why not? Yeah, it's all part of the, yeah.
But obviously the issue is if that margin debt were to be liquidated.
There could be some real problems.
The ETFs would be ground zero?
It could be one, yes, they have to, there is an interesting aspect of this, and there was a presentation a couple of years ago to, I think, the Senate Banking or Finance Committee that they asked to be done by a couple of academics, looking at the difference between the trading volumes of the ETF shares and the AUM in them and the underlying liquidity of the securities they hold. And it was pretty clear that in a market-driven decline, when these companies have to liquidate, they wanted to know, like, how long would it take to meet the selling demand? In some cases, it could be days or weeks. Now, the ETF rejoinder, the ETF manufacturer rejoinder is that, well, we use futures and so forth in different ways, swaps to provide the liquidity. But you know what that means. That's on paper. It doesn't it's not the way it cascades in real life. Yeah. Yes, sir.
Talking about, I think Bill made a comment that IPOs were sort of the most, least earnings in history. Who's buying them?
Nowadays, again, it's like George Soros talked about reflexivity. He just means that the market's a marketplace. People watch it, right? One action begets a reaction and so forth. So there are companies now, it's been for quite a few years now, where they actually plan their coming public specifically to get incorporated into an index, a significant index. So they'll work with the promoters or whatnot. They'll know in advance that if they come public at this price or this sector, that they'll get incorporated in a certain major index. And very often, you really look the way they do it, like in the Russell 2000 versus the 1000, near the bottom, near the borderline between one index and another, the companies are clearly, like egregiously not lined up by market cap. They're lined up by suitability to be liquid enough to fit in. So you'll get some company that's much smaller in market cap than it should be, that suddenly gets into the Russell 1000 because it can be used there. So that's part of the process now. Yeah. Okay, thanks very much.
All right, thank you very much. All right, we're gonna take about a 10 or 15-minute break here, so help yourselves coffee and refreshments outside, and we'll reconvene at 11 o'clock.
Okay, good morning, everyone. I'm Steve Rawl. I first started working with Bill as a college intern in the summer of 2003. Shortly after that, I started working full-time at Equinox, where I became the bank analyst. So in addition to going long lots of small niche EM banks, my first major project at Equinox was shorting the US housing bubble. So that has become sort of background for some of the things we're doing today that have a lot of echoes of what we did then. And now at Eschaton, I'm more of a generalist, so I'm no longer just a bank analyst. I do a lot of different things. So the focus of today's presentation is going to be some of the things we're doing on the short side. As preface, we want to say that shorting in general is extremely difficult to do. It's not something that we like doing, and we really only want to be doing it under extraordinary circumstances. So we've waited and we've waited and we've waited for years for the time to be right to put on a substantial short position. And we feel pretty strongly that the time to be doing that is now. So our primary goal on the short side is to find things where the risk-reward trade-off is skewed in our favor. And this is almost impossible to do on the short side, where more often it's the case that you are taking big risks for small rewards. But in the current environment, we think we found 3 different approaches to shorting that give us a favorable risk-reward trade-off. So the first is shorting European bonds. So right now across much of Europe, the short end of the curve is negative, the long end of the curve is very close to 0. And this is an environment where across Europe inflation is 2 to 3% and rising. So given the ultra low yields on these bonds, our carrying cost on this short position are very low. And because the bonds are already at the 0 bound, even under the most extreme circumstances, there's only so much the short can go against us. Whereas on the other hand, with rising inflation and the central banks telling us in very clear terms, particularly in Europe, that they're about to start pulling back on stimulus, we think we have a lot of potential upside on the bond short. Our second major theme is shorting Canadian and Australian housing bubbles. For us, we think of this theme as being very closely related to the Chinese housing bubble. A lot of the same capital is fueling all 3. And again, what we're doing here is very similar to what Bill and I did at Equinox before 2008, where we really focused on the most exposed financial institutions. And that worked out very well for us, and it also illustrated to us a very important point about shorting, which is that in very bad macro environments, financials are actually very attractive shorts. So what do I mean by an attractive short? So the best way to explain it is by comparison. What's the worst thing to short? So the worst thing to short typically is tech stocks. So tech stocks will often trade at crazy valuations, and this will attract value investors who look at them as attractive shorts because the valuations get so crazy. But the problem with this is that the really exciting tech stocks, the ones that tend to get to really crazy valuations, tend to be growth stories with a fixed cost structure, meaning lots of big economies of scale. They tend to be operating in a winner-take-all kind of space, either because of network effects or some other factor that creates natural monopoly-like competitive dynamics. And when you look at a business like this and you model it out in the future, you can start to get to values that are essentially infinite. And since there are no traditional valuation metrics that can appropriately capture or deal with infinite, tech investors often just start to ignore traditional valuation metrics. And so by the time you get to the peak of a bubble, these stocks will become totally untethered from reality. Once you're already trading at a crazy price, 2 times a crazy price is still just a crazy price. 3 times a crazy price is still just a crazy price. And there really are no limits to how high tech stocks can go before the eventual collapse. And this makes them very dangerous as shorts. By contrast, financials aren't exposed to this phenomenon of becoming untethered from reality. With banks or bank-like financial companies, valuations tend to be very tightly anchored to book value. So generally speaking, banks can only grow earnings more or less in proportion with the growth of their assets, and they can only grow assets more or less in proportion with their book value or their equity value. There are business reasons for these relationships, and there are also regulatory reasons for these relationships. And so relationships tend to be pretty tight. And so the consequence of this is that it's extremely rare, even for an extraordinary bank, to trade above, say, 3 times book value, particularly in the developed markets. So when you find a bank trading at 3 times book value at the top of a bubble that you think that is about to burst, that's a relatively low-risk short. And on the flip side, because of the leverage involved in banks in a bad macro environment, a lot of them can blow up and go to zero very quickly. So for example, in Australia right now, if 2 to 3% of the assets in the banking system go bad, that's going to wipe out half the equity in the system, which is going to trigger all kinds of problems on the liability side of the national balance sheet. And it's going to put the banks in a position of being forced to raise capital in the midst of a full-blown banking crisis. And that's just with 2 to 3% of the assets being wiped out as a consequence of the leverage. And if 5% go bad, the whole system gets wiped out. So given the work we've done on the Australian property market and financial system, those kinds of outcomes of 2, 3, 4, 5% of the assets going bad, those are definitely in play. There's potential for it to be substantially worse than that. And so given the leverage in the system, this is attractive on the short side. We think because the valuations are so high to begin with, we don't have a lot of risk. But because the leverage is so high and the macro scenario is so bad, we think this could potentially go to zero or get close to it. So the third major theme, I just got done explaining why tech stocks are a terrible idea to short. So our third theme, of course, is tech stocks. We're shorting tech stocks. Historically, for value investors in particular, shorting tech stocks has been semi-suicidal. Bill can tell you about shorting tech stocks in the 90s, where he turned out to be right about just about everything, and yet it still almost put him out of business. It's an extremely painful experience, and the danger of shorting tech stocks isn't just an artifact of the 90s bubble. In the last few years, there are a lot of very smart value investors who have lost a lot of money shorting things like Amazon and Netflix based on solid valuation principles, and it's been a nightmare for people doing that. So the question for us is, how are we doing this? How are we shorting tech stocks in a way that is low risk for us but high reward? And we fully admit that this sounds like an impossible task, but this is what I'm here to talk about today. So we're going to start with some of the lessons of the 90s, which is why we have this quote from Scott McNealy, who was the CEO of Sun Microsystems at the peak of the bubble. And he gave this quote in 2002. And it's not exactly the tightest logic, but the basic idea is right. Paying 10 times revenue for pretty much anything is an extremely high price to pay. You might even argue it's crazy to pay for almost anything, because very, very few companies are going to go on to justify that valuation. So what exactly is Scott McNealy talking about here? This is what he's talking about. This is Sun Microsystems during the late 90s, early 2000s. So in just a couple of years, the stock went from $4 a share to $64 a share, and then right back down to $4 a share. Sun Microsystems peaked at a market cap of $116 billion in 2000. And they eventually sold themselves to Oracle in 2009 at a market cap of $7 billion. So what's so interesting about Sun Microsystems is that this company, it wasn't like Webvan or eToys or some of these other famous IPOs from the 90s bubble, where they went bust, within 6 months of the IPO and never earned a penny. This company wasn't like that. So Sun Microsystems was a real business. At the time, this was one of the most exciting stocks in the market, and for good reason. They were building critical infrastructure for the internet, both software and hardware, and in a lot of the most important niches at the time, they were by far the dominant player. And it was obvious to everyone in the late 90s that this business, focusing on the growth of the internet and businesses like it, were the future. And it was a hugely profitable business. They were generating huge returns on capital. They were showing enormous top-line growth, revenue growth of 33%. And like a lot of tech businesses, they were showing real operating leverage. So you could grow your net income and your EPS much faster than your revenue as you had margin expansion because you had fixed costs. And so this is very exciting. And by mid-2000, this had been going on for years and years, quarter after quarter. This is one of the most reliable stocks in the market. And the other thing about this is that despite what Scott McNealy, the CEO, said in his quote, this valuation, it actually wasn't totally nuts. Yes, it was 10 times revenue, and that's a lot to pay for anything. But in this year, ended June 30th, 2000, Sun Microsystems generated $3 billion in free cash flow. And that figure had been growing at 50, 60, 70% a year for years. And so the question is, what is $3 billion in free cash flow growing at 60% a year? What is that worth in the market? At the peak, this traded at a market cap of $116 billion, which on a reasonable projection for next year's free cash flow of $5 billion, that's a free cash flow yield of about 4.5%, which really isn't that bad. The S&P 500 today is filled with companies with shrinking revenues that have free cash flow yields of 3%. So 4.5%, growing at 60%, it's not that crazy. But, you know, something obviously went wrong. So what happened? What happened here is this Sun Microsystems wasn't just a valuation short. The business itself actually, it collapsed. The revenues started shrinking, and the operating leverage dynamic started to going into reverse. So profits started shrinking faster than revenues were shrinking. They went from being a massive free cash flow generator to a massive free cash flow burner. On the way up, they had been compensating their employees almost entirely in stock, which was great when the stock was doubling or tripling every year. But on the way down, suddenly none of the employees are getting paid. Everyone is demoralized. And so they have to start paying people in cash, except now the rest of the business is now burning cash like crazy, and the stock is collapsing, so they can't raise new capital. And the whole thing just went into a death spiral. And this happened very fast. Just 2 or 3 years before, this was maybe the most exciting stock in the market, and now it's looking like it's not going to survive. So the question is, how does something like this happen and happen that quickly? And it turns out that even though Sun Microsystems was, at the time, it was legitimately was creating critical infrastructure for the internet, and some of which we're still using today. It turned out that by 2000, most of that infrastructure had been massively overbuilt. This was very hard to see at the time, because by the late 90s, there was a vast ecosystem of VC-backed, money-losing, value-destroying startups, things like Webvan and eToys, that at the time were using a flood of VC money to consume all of this infrastructure as fast as anyone could build it. Once the venture capital spigot got turned off, all of those users of this infrastructure disappeared, and it happened almost overnight. And that's when everyone realized suddenly that all this internet infrastructure had been massively overbuilt. It happened very quickly. And it's useful to remember that the bursting of the bubble affected everyone in the tech space. Obviously, companies like Sun Microsystems saw their businesses permanently impaired. But even companies that ended up winning, also got hit very badly. If you had the foresight to foresee what Amazon was going to become, you still would have had to ride out a 93% decline over a period of 2 years from peak to trough after this bubble. And that happened during a period where Amazon's revenues doubled. In the same period, the business doubled in size, the stock went down 93%. Which is probably the clearest illustration you can find that valuation does matter no matter how good the underlying business is. And it's also a reminder that when valuations in the market get really crazy, it's time to pull back and reconsider what's going on. Okay, so now we're going to flash forward to today. We're seeing a lot of these same dynamics play out all over again, except this time it might even be on a bigger scale. Whereas in the late 90s, a VC fund with a few $1 billion was considered huge, today we have VC funds with $100 billion in AUM. But it doesn't just stop there. So the SoftBank money, it goes into companies like Uber and WeWork, but then those companies then turn around and consume massive amounts of services from other companies in the ecosystem. And this money sloshes around in a reflexive way, with each company's costs becoming the next company's revenues. And even though almost nobody in the entire ecosystem is earning a profit, that doesn't matter. Because on the front end, there is this nonstop flood of VC capital coming into the system that's propping everything up and continually leading everyone to more and more revenues and bigger and bigger valuations. And everybody benefits all at once. The small money-losing startups maybe benefit most dramatically, but even the big profitable internet giants, the apex predators in the ecosystem, benefit from this dynamic. So we recently saw one prominent VC investor estimate that 40 cents out of every VC dollar almost immediately gets spent on advertising on the Google, Facebook, and Amazon platforms. So we don't have any way to confirm that number, but it's just one VC's ballpark estimate. But the size of the VC money that's in play right now, this is $100 billion in one fund. If that number is anything close to that, if the real number is anything close to 40 cents, the total market impact of this is enormous. But for the moment, at least, everyone is benefiting. This is all working out for everyone. So the SoftBank Vision Fund is important. Okay, the genesis of this fund, in some ways, this is the perfect microcosm for where we are in the cycle. So initially, the Vision Fund was planned to be $20 to $30 billion, which in itself would have been the largest VC fund in history. But as Masayoshi Son was literally on the plane to Saudi Arabia to pitch Mohammed bin Salman on the idea, he was still tinkering with the pitch deck, and he thought to himself, well, 20 billion would be nice, but 100 billion would be better. So literally on the plane to the meeting, he made a change in the PowerPoint deck where he changed the 20 to 100. And MBS, who, if there's nothing else we can say about him, he's a bold guy, upon hearing this pitch, basically immediately signed up for $45 billion of this fund. And so that's where we are in the cycle. The idea that you can just, on a whim, add $80 billion of capacity to your VC fund without any economic logic or rationale or any plan for where the money is going to go, and then pretty much immediately get it funded, this sort of says it all. So the best part about this is Masayoshi Son says he's not done. He says he's going to raise another $100 billion next year and another $100 billion the year after that. And at some point, the numbers don't even mean anything. I'm sure he'll be at $1 trillion, sooner or later. So the consequences of this flood of money aren't just financial, they're also cultural. So this is a recent quote from the Airbnb CEO. The scorecard for companies has changed. Before it was really about financial metrics, and I think now companies are realizing we have a greater responsibility to society to make sure life is great. Airbnb is a $30 billion company. It's one of the 200 largest companies in the United States. And so this sort of an attitude, it's not an aberration. This is the standard now, not just at this company and not just in Silicon Valley. This is the standard attitude. Corporate managers don't care about financial metrics, or they care certainly a lot less than they used to. And for now, at least, again, this is all making sense for pretty much everyone involved. Almost no matter what you are doing in the startup space, right now, there's always a greater fool who will buy it for a higher price. SoftBank right now is playing this role for a lot of people. But at the very end of the chain, ultimately, it's the central banks who are the buyer of last resort for all global assets, including everything that comes out of the other side of this startup ecosystem. But one of the key points about this, and this underlies almost everything we're doing, not just in this theme, is that the central banks are very clear that they're reversing this policy. Absent massive central bank stimulus, there aren't going to be any more $100 billion vision funds. The venture capital spigot, which has been gushing for a decade, is about to get turned off, and this is going to have serious consequences for a lot of profitless, cash-burning companies. So remember the Scott McNealy quote from the beginning about companies trading above 10 times revenues and how that's a crazy metric that no one should ever trade above. So right now in the S&P 500, there are 31 companies trading at a price to sales, price to revenues above 10 times. In the Russell 2000, there are 232 companies, and in the Russell, there are also 59 companies trading at a price of sales greater than 100 times revenues, which is really crazy. It's 10 times the number that was already way too crazy. And as Bill mentioned, 40% of the companies in the Russell 2000, are losing money. The Russell, if you really dig into what's there, this is an accident waiting to happen. It's being, fueled by ETF money, but when you look at the individual companies, it's unbelievable how bad it is. I could talk all day about the Russell. You can pin me down later if you want to hear more about it. So of course, what everyone's wondering right now is where do the FANG stocks fit into this picture? And we want to be clear, we aren't short the FANG stocks. We don't want to be short the FANG stocks. We view this as the opposite of low risk, high reward shorting. And the main issue for us with these is that the businesses are they're too good. So in a bear market, the valuations, which are very high right now, will almost certainly come in, but these businesses are very likely going to survive. In some cases, they're likely to thrive for decades, and we just don't want to be short things like that. We want to be short things that are really expensive and that are about to go to zero. I mean, that's the goal. We're looking for things where the business is not going to survive. So Google and Facebook, these are both fantastic businesses with huge returns on capital, massive free cash flow generation, and really strong network effects that suggest they may be durable monopolies. The only real risk we see would be something coming out of the blue, like some of the things Steve Bregman was mentioning, or maybe regulatory risk. The regulatory risk may not be that small at this point, but if you look at the valuations, they're really not that crazy. So Facebook is trading at 20 times GAAP earnings right now. If you make some reasonable adjustments, you can argue it's much cheaper than that. Google is the same at 25 times earnings. And with the market as a whole trading not much below that, we don't want to be short great companies, period, and we certainly don't want to be short them at not crazy valuations. Probably the next in terms of quality for us would be Apple. The bulk of this business is the iPhone, which is a great product, and the ultimate durability of our hardware franchise may be more questionable than what Facebook and Google have, but this is trading at 16 times earnings, and for me at least, that would be closer to a long than a short. on Apple. Amazon is probably the hardest case for us. They really don't make very much money today, but it's clear that they have a real franchise and a lot of latent pricing power. There are some questions about how fast they could continue to grow if they exercised that pricing power, and there's some potential antitrust issues, but all that said, this is not a company we want to short. These are examples of things we don't want to short. Netflix is probably the one I would personally at least want to own long term. It's not clear that they have a real franchise, maybe not, but the space that they're in is very much in flux. There are a bunch of tough new competitors like Disney that are about to enter. Unlike the other four companies, Netflix is a massive cash burner, and the accounting is very aggressive. So they've made a decision to capitalize their content production cost, which is by far their biggest cost, and that has the effect of making their income statement look much better than a conservative accounting treatment would show. But all that said, Netflix has massive subscriber growth, massive revenue growth. They're getting a lot of traction with the idea that they're going to be the winner in a winner-take-all space, and we're not shorting things like that. So what do we want to be short? So the zombie stocks have been a real theme for us. So a zombie stock is a company that does not earn enough EBITDA to cover its interest payments. And that's not referring to the principal. That means they literally can't afford to pay the interest on their debt. So in other words, these are stocks that are losing enormous amounts of money and need to continually raise capital just to stay alive. So right now, in the US, there are about 1,000 zombie stocks. It's a shockingly high number. So the really amazing thing about the zombies is their relative performance. So these numbers are as of a couple days ago. The S&P 500 is up 4% year to date. If you just take the average performance of the equal weighted average performance of 1,000 zombies, they were up 20% year to date. And if you just took the 100 largest, they were up 39%. But the key point for us here is that there are 289 zombie stocks trading at a price to sales of greater than 10 times. So I guess sort of the punchline of the presentation is that right now there are 289 companies in the US that on a fundamental basis look like Sun Microsystems did in 2003. But on a valuation basis, they're trading where Sun Microsystems traded in 2000. And so this is an extraordinary phenomenon. On the short side, it represents an extraordinary opportunity. And so as a firm, we've been through every single one of these companies. And within this group, some of the main themes we're focusing on are, one, we like companies in an obvious winner-take-all market where somebody else has obviously already won. Two, we like companies that without pricing power and have a variable cost structure. In other words, they have no economies of scale. So if you are already a zombie today and you have no pricing power and you have no economies of scale, you have no path to profitability. It doesn't matter how much you grow, there's no way you can ever get out of the hole that you're in. And three, we're looking for companies with the Sun Microsystems problem. So we like companies where the entire business is selling into the startup ecosystem, which in our view is on its last legs. So typically we're finding these companies with one of two kinds of managements. The first is what we would call the delusional, where they still clearly believe that everything's going to work out. Typically, these are the ones that have set themselves up with a dual-class share structure where they have all the voting power and shareholders have none. They're also obviously running the company into the ground, doing all kinds of crazy, reckless things. And these are almost always the companies that loudly claim to have a social mission and sort of trumpet this all the time. The second kind of management is the cynical, where the management obviously knows that they're in an untenable position, and so what they're doing is they're issuing themselves massive amounts of stock and then selling it into the market as fast as they can, and there are a shockingly high number of companies doing this right now. And remember, everything I'm talking about here, these are all companies trading, these are zombies, these are trading above 10 times price to sales, and fundamentally, they look like Sun Microsystems in 2003, valuation, they look like Sun Microsystems in 2000. So, sort of moving towards the conclusion, we don't want to be flippant about this theme that we're doing. So shorting tech stocks is always risky. I meant what I said at the beginning about why shorting tech stocks is very difficult to do. When it comes to this theme, what we spend almost all our time talking about is how do we control the risk? What happens if we're wrong? And one of the things we keep going back to is these can't just be valuation shorts. In other words, they can't be like the FANG stocks. We have to have a strong reason to believe that the business isn't going to survive, and we mean that in the relatively short term. These are not 10-year bets. We want companies with serious cash burn problems or debt refinancing problems that put a terminal date on the business. And so we are focusing on our efforts on finding companies where the story is already broken. These are all story stocks in one way or another, and we want a broken story where the users, the revenue growth have already rolled over, or some other thing has clearly gone wrong in the business that puts them in an untenable position. And so we're only really working within that population of stocks. And so when you combine a broken story with a competitive structure that they can't win, or where they've obviously already lost, and it's already a zombie, and it's already trading at a crazy valuation, and it has a terminal date on the business because of cash or debt problems, if we can get all these things into one package, that presents a really attractive risk-reward proposition on the short side for any stock, whether it's tech or not. And so right now we've got 7 individual names in this theme. This is all, we've put this all together in the last few months. We've got a few more names that we think are close, and depending on what happens fundamentally in the next couple quarters, we're likely to add to this position. And you know, it's as crazy as it sounds. We think we found a way to short tech stocks in a way that's low risk and high reward for us. Now, unfortunately, we're not going to discuss any individual names, but happy to take any questions on.
Did you have a quantitative screen that you define as to what a zombie is?
Yeah, so you know, Bloomberg or Reuters, you can run a screen whose interest payment is greater than their EBITDA, and that's the screen we got, and it's close to 1,000 names in the U.S. I ran this in a bunch of different countries, and the U.S. is basically the only country that looks like this. This is very rare globally. It's in almost every other country, it's a handful.
Why only 7 shorts? It seems like a fair degree of concentration.
Yeah, well, one of the issues here is, so this is the problem. So if you start diversifying, your risk is big. Now we think the market is about to, well, I don't know, I'm not going to make predictions, but we think the market, it's more likely to roll over now than, you know, we're feeling pretty confident based on the last month that we may have been, you know, we may have just been near a top. And so if that's the case, everything's going to work. But if we're wrong, we don't want to own these on average. If the market has another year to go, we're going to get crushed in this theme if we just own all 1,000. And so what we're trying to do is be very careful about only picking the absolute worst businesses, really where the business is just not going to survive. And you know, if we can find those that are still trading at this crazy valuation, you know, those are the names we want to be focusing on, where even if the market continues to go up, these things are in serious trouble because there's cash burn problems or a debt refinancing problem that they're just not going to be able to do. They're not going to be able to sustain themselves over the next year.
Yeah, so I'll just put a footnote to this. If you think about our short portfolio in terms of the amount of exposure versus the amount of risk, we have progressively put on a little more risk as the last year or two have gone by. So we have a very large position in what we think are basically riskless shorts on the bond side, but of course the returns are not going to be as good. We think that the property bubble financial companies are a terrific short, and there's a lot of possibility of going down a lot with virtually no risk to us. We've also shorted indexes, as Steve Bregman has talked about. We think there is, in indexes in general, we think there's a possibility of this reversing itself. And so indexes we have as U.S. indexes, we have as short exposure. This theme is very new. Part of what I think makes this interesting for us is the total reliance so many of these companies have on compensating their employees with their own shares. You want to talk about that a bit more, because I was shocked when I saw the amount of non-cash compensation that goes.
Yeah, well, at most of these companies, you know, it's mostly because they're not generating any cash. The compensation will be upwards of 80% of compensation will be stock-based compensation. When the numbers will be huge, and you know, these are almost all tech company, you know, that are in a very you know, competitive market for labor, and you have to pay engineers a lot, and so they're offering enormous amounts of stock. And this really works when the stock is going up very fast, but it's an upcycle model. This happened to some microsystems. In the down cycle, it does not work. You start to have enormous amounts of problems, and you can't afford to do it, and your employees won't work for an 80% pay cut. So
in a sense, if this goes into, if we start to see prices
Yeah, I mean, in general, we want, the 7 names we're short, everything is going in our favor. So it wouldn't, the capital structure is one part of the thing, but the business is in real trouble aside from the capital structure. So yeah, yes, I mean, there's always the issue, you know, if, you know, 10 Cent comes in and, you know, buys whatever at a huge valuation, yeah, that's a risk. That's probably, you know, one of the main risks we're concerned about for all these things. Or debt, or yeah.
Pretend to extend some.
Yeah, that's a risk. But in general, these aren't like distress. I mean, they're not, stocks aren't trading like they're distressed. It's not like you'd get some huge pop on that. They'd probably have to go down a long way before, you know, the market would get really excited about a new, you know, debt, you know, being able to refinance their debt. Yeah, there's risks. I mean, there's definitely a risk here. But we think what we're trying to do, there's a reason why, you know, we went from 289 names down to 7, is we really think we have the worst of the worst here.
I think at one point you were short Tesla, as I recall. Are you still, and how's that position looking to you?
You want to do that, or you want to?
Yeah, we still have some short of Tesla. We pulled it in quite a bit after clearly they're not gonna go bankrupt in the next couple months. We've done a lot of work on Tesla, and Tesla checks a lot of these boxes. We think that there is, that we've just seen the best quarter, as David Einhorn said, we think we've just seen the best quarter that Tesla's gonna report. And as the stock goes higher, and you've covered most of it, and as the short exposure comes in some, and maybe a fair amount, I would expect to revisit that or increase that position. But we did pull it in given the results that he showed the other day. I think that's a one-time event.
Of the 7 that you decided upon, how did that split between the two types of management teams you described?
That's a good question. I think off the top of my head, we have probably 5 and 2. 5 being delusional and 2 being cynical. Some are more than others. I mean, there's some really egregious examples of both, actually, out there. Yeah, it's pretty, yeah, just what's going on. And the management of these types of companies will, you know, it'll make you sick at some point. Seeing how these managers are running the companies, the way they're abusing the shareholders. So yeah, it's entertaining in some ways to dig into these.
Stephen, how many of these 7 have you, if any, have you visited and actually met with management, or is it done by just looking at the public filings?
It's done by looking at the public filings. We have not visited any of these shorts. These tend to be big companies where we would just get IR. I mean, these aren't microcaps we're doing. Maybe I should have mentioned that. These are all, I think they're all at least 10 billion in market cap. You know, going to visit them is probably, we'd get a junior IR person. So yeah, this is being done in the public filings.
We were short Tesla for a while, but Elon won't take my phone calls.
Right. Yeah, so these would be like Tesla scale companies.
Doesn't work.
So obviously the equity is trading okay, you said not just showing distress. What's the debt cost?
For many, you know, they're almost all trading like Tesla debt, which is close to par. Yeah, the market is, you know, the last month, you know, notwithstanding, the market is not worried about any of these companies. I mean, the equity valuations are all stratospherically high, so no one's concerned about the debt on any of these right now.
As long as these companies can issue shares at the crazy valuations, I mean, the debt's fine.
Yeah.
Tesla's debt's fine, as long as if they ever issue shares.
Are you doing the index short through futures or ETFs?
We have them back there.
Just how has the short book been performing recently?
Very well in October. Tesla aside, the rest of it has done well. Most of these are fairly new shorts, so far it looks like we timed it pretty well. So we didn't get hurt on the way up. Anyone else?
As a market parameter, have you looked historically how many zombies
Yeah, so I tried to, it would have been really great to get like solid data on the late 90s for exactly what it was, and I wasn't able to do that. This research project is ongoing. I'm still digging. But yeah, I mean, anecdotally, there are more mega caps trading above 10 times sales now, maybe more in size, although I don't know, some of the really crazy stuff that was happening in the late 90s obviously isn't happening today. So the NASDAQ going up 90% in a quarter, like this is not what we're looking at today.
Is there a risk, in your opinion, that the banks will extend and pretend as the Japanese banks did after 1989?
Yes.
Australia.
No, 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 in
Property. No, for the tech stuff.
tech, yeah.
Yeah, we definitely, that's definitely a risk. That's definitely a risk. In general, yeah, I mean, sort of we're also, we want a bad capital structure. We also want just really bad business problems where, as I said, sometimes you find these things that'll be trading at, 13 times sales and they're losing $3 billion a year and they're in an obvious winner-take-all space where someone else has obviously won and yet they're still trading at this crazy valuation and in some cases the growth is already rolled over and they're still trading at the crazy valuation. And so if someone refinances, that's a problem, I guess, but.
It's true as well that the Japanese banks did extend and pretend because the government won't.
Yeah.
Right. The point, to that point, in terms of the Australian property shorts, indeed, the backdrop for Australia is just the opposite. And we talked about this in the Fred Williams interview. The real focal point for us in the terms of Australia came with this royal commission that started last spring, in which an outside commission went through and cataloged all these abuses that the banks were taking advantage of their customers. And among the very greatest were, as we had suspected, the data on the ability of the customer to pay back the loan. It was fraudulent. It was, I mean, it's just shocking the number that we think there's a third of the mortgages in Australia are wire, third. I mean, that's a huge number of loans started. So we think the government's on the other side of this, enforcing banks to take a more cautious view. And there's also, just as a footnote to this, it's pretty interesting. There's a law that was passed in Australia, as far as I know, it doesn't exist anywhere else, that says it is the responsibility of the bank to make sure that the customer can pay mortgage. So there is a law, unlike I think anywhere else that we know of, that puts the onus of responsible lending on the bank as opposed to the individual. Now, as all these people, you'll see a little video at lunch, as this starts to be a real problem for a lot of people, it'll be interesting to see the legal ramifications of that law on terms of people that borrowed money that shouldn't have gotten a loan. It happened here, but those people, there wasn't a law that the banks had to be responsible. It is in Australia. So we think the Australian bank short is also, that's very low risk and a very high return. But we want to spread our shorts out a bit, and we've increased it modestly here. But again, it's not something we're going to make a real big bet on. Other questions? Yeah.
For the Aussie, and you're the Canadian housing short too, is that the most important financials, or do you also have currency positions on? So I saw a currency basket in the themes section.
Well, yeah, so to answer the first question, yeah, we think the currency is a big part of the story. So one of the things that makes Australia and Canada today different from what we did in the US 10 years ago is that in the US 10 years ago, when the crisis happened, it was a worldwide crisis and the dollar went up. It was the safe reserve currency. This is the safe haven. Money flooded into the US in the midst of this, crazy crisis. That's not going to happen in Canada and Australia. So in Canada, Australia, when these bubbles start to burst and there's more stress in the financial system, the currency is going to go the other way. Particularly in Australia, where a third of the bank liabilities are wholesale funding and a large percentage of that is from offshore. And so once that currency starts to decline, all of a sudden a third of their liabilities start to get much more expensive. And the people investing in the wholesale liabilities, they have to suffer the currency risk. And so there's going to be a lot more reluctance to fund these banks from offshore. And that's going to put a lot of pressure on the currency. So yeah, the currency is definitely part of this bet. The the currency thing and the attribution is a catch-all that captures everything. So the negative performance on that isn't just Canada and Australia, which the currencies are actually, I think, gone in our favor a little bit this year.
Are your zombie shorts limited to the tech sector because that's where they all are? Or are you limiting them to that sector for other reasons like, technological obsolescence?
It's not yeah, we didn't have an artificial constraint that we only want tech. It just happens that almost all of them are tech. There's a lot of pharma and biotech stuff that fit this description that we are not doing because it's a different set of risks. So yeah, they just tend to be tech. And Tesla, is that a tech company? Maybe not. So there's some things that maybe you could argue or one way or another. But yeah, generally speaking, people would group these stocks as tech stocks. Yeah.
So you mentioned the Chinese housing market beating into Australia and Canada. What do you think of the renminbi then in this situation?
So China is a big topic. We are also bearish on the RMB. We are actively, the genesis of the Canada and Australia shorts to begin with, we're looking for ways to short China. And so ways to short China in an efficient way where the government can't, pull the rug out from under you. This is something we've been looking for years. And we're continuing to try to add to this position. But Canada and Australia have turned out, we think, are probably the best risk-reward way to short China, because so much of the story in those two countries has been fueled by Chinese capital. And with that capital starting to be cut off, these countries are in trouble.
Right. So then if you combine your currency exposure is basically very dollar positive. Do you not feel like you're a bit early on the precious metals then?
We have been, for sure.
Yeah.
Look at the numbers. How much shorter should we wait for the commitment of traders before it's time to? I don't know. The first time in 20 years there's a net short, and that is way out of favor. We've had this position for a long, long time, and yes, for sure, like everything else, we've been early.
I point out the precious metals as being early because it's contradictory some of the other positions. Not contradictory.
I don't know that that's the case. Who knows what's going to happen with central banks when asset prices start to decline? We don't. But I think the precious metals might be a hedge for that.
Anyone else? All right, thank you.
Mark Yusko, who some of you know of as a market commentator, talks about what to look for when you're hiring a money management firm. And he says that he never looks at performance, past performance. He looks at the people and the process. Now, this morning, you've heard a lot about the process, and you've heard what we're doing and why, and so, and many of you have known me for a long, long time. You know the process, which is pretty much the same in my case. So the people side of things, I think, are important, and we haven't talked about them. Unfortunately, Ralph Shaul, who is our COO and Chief Compliance Officer, couldn't make it up here today because recently he had back surgery, spinal surgery. The good news is the spinal stenosis that he was suffering a lot of pain from the spinal stenosis has been cured, but we didn't want him to get on an airplane and come up here to meet you today. But Ralph is an example of something that I'm very proud of, and that is the building up of the team of Eschaton. We have a small but highly professional team, and I urge you to look at the bios that you get. I think Jason's going to have them after the meeting. Look at Ralph's background. He's worked for Soros and all kind of other people. In this position in Florida, it's really unusual that we were able to hire somebody like that. He's a great guy. We're very happy to have him. I'm sorry he's not here to meet you today. I also want to point out that Jason, standing in the back, basically runs our operation, and again, an extraordinarily successful operation that he runs because he's really good at his job. And again, we're very lucky to have him. The three investment professionals you've seen today, and you're going to meet Lily in a minute, round out the rest of the team. So again, we're a small, but I think I'm very, very pleased with the people. I've worked with Lilia and Steve for many years. I know them well, and I think they're very good analysts. On the screen are the outside people that we work with, and I want to recognize them because they're also very important to our operation. We couldn't do this without these people, and I want to start with the Goldman Sachs prime brokerage relationship. Jim, will you and Julia hold up your hand? We have two of their representatives here today, and we use Goldman Sachs a lot. We find them very, very helpful, and again, we're very pleased to have this relationship. We also have some very top flight service providers in Kirkland & Ellis out of Chicago is one of the top hedge fund law firms. Eisner Amper is an interesting story. Mike Mazzola came down to Florida about the same time I did. He was with Anken Block & Anken here in New York, and I worked with him for 20 years on the Equinox portfolio. When he moved to Miami, he joined Eisner, and he's become our auditor and accountant. We use these people not only to do these functions, but also to give us business advice, to give us help in all kind of other things. And I've known Michael for years, and he's a very good sounding board for me in terms of running the business. SS&C is our global administrator. So the four major service providers that we have are name brand, high-level service providers we're very proud of. And then also we use AlphaDesk as an order management system. We have a local firm, HydroSync, that helps us with the technology issues, and they do a good job. And then there's another interesting system that we're using. We use a portfolio optimization theory, or a firm called Alpha Theory, which helps us organize the portfolio, and they've been useful to us too. So these are the kind of the main players that work at Eschaton. I don't want to spend a lot of time on this. You can meet these people and talk to them here today, or talk to us about it later. But these are the major players in terms of the people side. All right, I'm going to turn to our last presentation. We have for many years been involved in a sector that most people call emerging markets. I've been doing this since the 1990s, and I personally traveling around the world. And I maintain that there is no such thing as an emerging markets sector of the stock market, because these markets are quite distinct and varied, and they shouldn't be lumped together. Discriminating investors can choose between them, and the City of London Investment Group does exactly that for institutional investors. So this morning, Lilia is going to introduce you to its CEO, Barry Olaf.
At Eschaton, we're looking for highly profitable companies that have competitive structures that are hard to replicate. They also should have a long runway of reinvesting opportunities. Or if they don't have those, they should have a sound capital allocation policy. Normally, these businesses are quite expensive, and sometimes if they're small enough and they are in a bad sector, you can get them at the attractive prices. So let me introduce you to one of our portfolio companies, and also one of those rare companies, City of London Investment Group. Stock ticker is CLIG, CLIG, in a short way. CLIG is an asset management company that primarily focusing on investing in emerging market closed-end funds for institutional investors. In our portfolio, we also have emerging market companies, but those are real operating businesses in the select countries. We have 5 of them. They are in India, Africa, Brazil, Indonesia, and Mexico right now. But we like CLIG because it does something different. So I want to tell you a little bit more about this. First, we like their business model. This is an asset management company. This business we know well because we are in it ourselves. It's asset light. It has a high operating leverage. So essentially what it means is that if your AUM grows because of new inflows or appreciation of your funds, you don't need incremental capital. So in this you see in the profitability of City of London, their return on assets is 30 to 40%, return on equity 40 to 50%. Second, we like and trust management. We did some field trips. We met the investment team of City of London. This company is founded and managed for more than 20 years by Barry Olive, who kindly agreed to present today at our Investor Day. So you can see manifestation of this great team at the transparent guidance they give every year. They also have a sound capital allocation policy where most of the excess capital is get paid out in forms of dividends. Right now, the stock yielding 7.5% yield. Another example would be their expense structure. It's predictable, it's stable. Employees are compensated in a fair and stable fashion in form of salary plus 30% profit share. Then G&A, general administrative expense, is frugal. Given its name, City of London, you would imagine their headquarters to be in something like this, somewhere in expensive neighborhood, financial neighborhood of London. But the reality is different. Click chooses to have its headquarters in a renovated farmhouse, an hour and a half away from downtown Philadelphia. Everything you want to know about this management and its culture is illustrated in this example. Now let's talk about valuation. So this is a small market cap. It's profitable. It has a nice dividend yield, but it's trading at 10 times earnings. So why is that? Why is it so cheap? The stock is at the trifecta of negative sentiment, in our opinion. First, as Steve Bregman explained, this is a small, illiquid stock, number one. It's active asset manager, which is also out of favor. And finally, they are investing in emerging markets, which is also out of favor. You can see this in this example. So S&P 500 in the last 8 years more than double, and emerging markets were flat, essentially. You can look at different other measurements like multiple on price to earnings ratio. On that measure, emerging markets are the cheapest since 2005. And finally, it's my last point, is that Click's underlying closed-end funds are also out of favor. They're trading right now at the highest discount to net asset value. Without further ado, I'm excited to introduce you to CEO and the founder of City of London, Barry Olive.
Lydia. I'm a closed-end fund guy. Sort of a sleepy old asset class. Most people have not even heard of them. Probably a good idea to start off by actually explaining what a closed-end fund is, because they were launched first in Edinburgh and Aberdeen back in 1860. So they well predate mutual funds and ETFs. So closed-end fund is basically a corporation with a fixed capital structure. So unlike a mutual fund where the manager takes account of supply and demand, so the share price and the underlying NAV is always the same. In a closed-end fund, it's a fixed capital structure. Shares trade on a stock market somewhere or other. And the market takes account of supply and demand, which means that in periods of euphoria, shares will trade at a premium to the underlying NAV. In periods of despondency, depression, as we're having in the emerging markets at the moment, they trade at wide discounts. Most of the portfolios are fully fungible. Most of them can be liquidated in a day or two, not in every case. But it's worth making the point that there are about 4,500 closed-end funds around the world, listed in 32 different financial centers. So whilst some of you might know a little bit about the New York funds, our business model is to know about all of the funds, not just the emerging funds, the developed funds, the frontier funds, the munis, and the MLPs. I made my first investment in a closed-end fund in 1962, so that sort of dates me. And I was obviously privileged to start City London in 1991. As implied, we manage money for US institutions. We don't do retail, we don't advertise, we've never advertised. Entirely word of mouth, recommendations, we deal through consultants. So no one's heard of us, so why get a listing? Well, main reason for getting a listing was because I wasn't going to sell the business to someone else who was going to effectively be a consolidator. I wanted us to remain independent. But separate from the points that have already been made, we actually run the business extremely conservatively. So in spite of having a market cap of £110 million, we actually have something of the order of £20 million on the balance sheet. And we do that, it's sort of rainy day money. At some point, we'll either distribute it to shareholders. We certainly won't invest it to staff, certainly won't give it back to staff, because they've got their deal, which is 30% of the operating profit. But that 20% either will get back to shareholders at some point, or else we'll do a transaction. And our basic model with regard to doing a transaction is that we would only do one in the event that we could show earnings enhancement of the order of 20%. So that money isn't going to finish up in someone's pockets, it's going to finish up in shareholders' pockets. Just to try to give you this in a context, we would say there are probably 25, and it depends on which index provider you look at, but there are about 25 developed countries, there are about 40 emerging countries, and there are about 35 frontier countries. So there are about 100 stock markets around the world which have listings of different securities. Some of them are easy to access, some of them aren't easy to access. Of the 5 billion that we run, circa 4 billion is in emerging. We were an emerging market business. When I started the business, as I say, back in 1991, it was the closed-end funds providing emerging markets exposure that were the most attractive via their discounts. Our share price has roughly doubled the performance of the emerging market index. And so as we've developed our business to the extent that we've now got only 80% of our assets exposed to emerging markets, with the rest exposed to developed and frontier and munis. So we've taken advantage of discounts, discount volatility, and obviously had a sensible country allocation process into the bargain to make sure that we don't make stupid mistakes against the benchmark. So what we're trying to do is we're trying to provide returns for shareholders. So we don't invest in these emerging markets as principal. We're investing in emerging markets and these other various markets as agent for clients. And those clients are foundations, pension funds, and they are really giving us what I would call very sticky money. This is 5, 10-year money. This is money that it's us to screw up. We don't screw it up because we're very conservative, we're very low-key, we're quite ponderous. As I said, we have a very, very open way of doing business. We're not the people that are going to make quick decisions. We will be the people who gradually buy into a country or gradually sell out of a country. The macro team don't make big bets. We don't make big bets. That's the way to run a business, and that model is in line with what our clients want too. Profitability, 77 basis points. Not bad in this environment. There is some margin pressure, but it's not really significant. It's worth making the point also that the double benefit we have in the exposure that we're providing to our clients is that we're actually investing in active managers. So we're at that end of the market as well. So we're a deep value shop investing in a concept that you could say at the moment is out of favor. But our clients get that because they understand it. They see the numbers every month and they understand how it is we run our business. This is the performance, total return of City of London. We are that gold. You might not be able to see the lines there. We're the gold at the top. The light blue in the middle is our benchmark. So that is our benchmark, and that's us up at the top. And that's comparing us with a few other names that you'd be familiar with. Franklin Templeton, Aberdeen, now Standard Life, Ashmore Schroders, Janus Henderson, Polar Capital, all people with significant emerging market businesses stroke exposure. So their performance should go up and down with the emerging market index to some extent. There are three stakeholders in any listed company. A lot of companies, a lot of CEOs don't understand that. They see and don't understand the conflict between staff, employees, and end users, i.e. clients. We like to spell this out. This is what we believe that those stakeholders expect, and we respect those requirements. And the reason that we've been relatively successful, and we've had people who've stayed at the firm for 10, 15, 20 years, is because we look after staff, but also we have clients. We have many clients who've been with us since 1995, which is when I moved here. And we got that office that you were shown a little bit earlier on, the barn. But the bottom line is that if you treat people fairly, honestly, and you're not opaque in your dealings with them, then, and you're a little bit old-fashioned possibly, then you actually can run a listed company, a small-cap company, relatively inexpensively and achieve your ambition, which is to remain fiercely independent. A few points with regard to strategy and objectives. I've mentioned some of these already, but keeping costs down is very important. Frugal, yep, nice word. Don't stay in fancy hotels, don't have fancy lifestyle, try and be long-term, try and find decent people. Possibly this isn't the place to come to not find relatively, and I'm not being rude and talking out of turn in this room, but you know, financial centers encourage greed. We don't. We don't pay greedy salaries. People who work for our firm are not looking for greedy rewards. There is something beyond your work. And if you can identify people who have got similar views to your own, in other words, trying to treat people decently, try and be honest with your clients, be straight with your shareholders, then I think you actually can run a business. It's increasingly difficult because greed it's there, it's out there, but there are people who will work for a fair salary and do a really good job. This is what we call forward guidance. We're trying to show not what the market's going to do, but what the impact would be on our P&L based upon a number of key assumptions, which are shown down the bottom left. This is going to be very difficult for you to read in the room, I know. But it's quite an important component of how we are dealing with our shareholders. No nasty surprises, virtually fixed overheads, virtually, staff, property, no trading in the stock market. We've got a risky enough asset class that we're exposed to, so no reason to trade in the stock market. But the bottom line is that shareholders seem to like this, and it also holds us to order. This is on our website, monthly data. Funds under management, income, costs. Look at that red line. Very proud of that. There's a lot of data there, but that red line's not far off straight. That's cost controls. Recent results. Dividend history. Just increased the dividend. Dividend cover's now 1.5 times. That was obviously a very good year last year. This year won't be as good. Emerging markets are down, as you know, 15%, something of that order of magnitude. But nevertheless, with 20 million in the bank, who knows, we might even be able to increase the dividend this year. That's the income statement. Balance sheet. So net assets, 21 million. A lot of free cash flow. That's quite an interesting graph. It shows the relationship between fixed and variable costs. I can give anybody who wants this information, I can give it to you because it's a little bit detailed. It's quite small in terms of the writing as well. We're so confident in our ability to forecast our P&L that we actually put out this table which shows the relationship between the cost structure of the business and the exchange rate. If you think about it, 200 institutional clients in the US, if that US income comes over to the UK at a specific exchange rate based upon perfectly reasonable and stable assumptions, and you've got a fixed overhead, you can actually forecast the P&L based upon given funds under management. Well, that's what that table is, and that's on our website as well. Strategic positioning, we're all about teams, not about the individual. We see the competition as outside, not inside the firm. We don't have any hot money. We discourage it. We're looking for a high margin. We could sell a lot of emerging market product at the moment at 0.3, but our emerging market fee rate is 0.8. Very high. Even developed market fee rate is 0.6. There are many people who are writing business at 0.2, but there's no point. You just have to be patient, use your professional judgment, wait for a different point in the cycle. On the other hand, there are other areas of the market that we think are quite attractive, like Frontier is quite an attractive asset class. REITs, we think, are a really attractive asset class. REITs are closed-end funds at the end of the day. They just own the underlying. Trade at discounts, discount volatility, exactly the same principle. Philosophy, drivers to our business. Investment performance, well, 20 plus years of outperformance. First or second quartile performance for every 3-year period since inception. That's how we can write business at 0.8. We speak a lot of languages between us. I don't, but colleagues do. This is the performance I was talking to you about. These are all net numbers. And as I say, this is all on our website. There are the quartile breaks. I don't know if you're familiar with this data, but this is Investment Alliance data of emerging market institutional managers in the US. The trick is to be up the top in the first or second quartile, and that's that red blob, that's us. This is a really interesting graph. This is the SWOD, size-weighted average discount. This is taking the size-weighted influence of the discount across our portfolios and looking back over a 10-year period of how that valuation metrics through the market comes through to our valuation. So these are some of the parts calculations based upon where we have exposure, which is to 18 different stock markets, 32 different countries, but 18 different stock markets, of which one would be here, also London, obviously, China and places like that. But it then looks at the size-weighted discount of each of the securities that's in our portfolio. Now, if you look at the average of the averages, it's 8. You go back to the first emerging market fund that was ever launched at net asset value, which was a Genesis fund, which was launched in London 32 years ago. That fund for a long time traded at a premium. If you look at the average of the averages for all that period, it's 8. So 8 is the long-term valuation average of the closed-end fund sector shown through the prism of a closed-end fund. Now, bear in mind what I said earlier on, these are all fully fungible portfolios. They can all be got rid of in a couple of days. And so you should have some conditioning factors going on here, because you can liquidate these funds. You get enough shareholders to agree with you, you can liquidate a fund. And here we are with discounts as wide as 13, 14, 15, 16%. 6 US closed-end funds providing emerging markets exposure have been liquidated in the last 18 months. We have a big book of business here because discounts have been wider, longer than ever before. So this is the ultimate deep value play, and you could say it's a value play on value, because depending on how you want to look at it, you could say the closed-end funds are extraordinarily cheap and a cheap asset class, with the exposure being provided by active managers who are out of favor themselves, which is possibly why you're owning nearly 5% of our stock. Oops. This is the... let's get back to that clock. There we are. 24-hour clock. We have an office in London, which isn't in Threadneedle Street, but that is the original 1991 office. And there they trade all the closed-end funds that we can get exposure to, or trade, or research on the London time zone. So we look at countries such as South Africa, parts of sub-Saharan Africa, Europe, and obviously London, including Ireland, where there are closed-end funds. They look after those in London. In just outside Philadelphia, where I am, we trade the New York names, we trade names out of Toronto, Vancouver, and Latin America. In Singapore, where we have an office, we trade the Asian markets, and Dubai, where we have an office, we're trading the Middle Eastern markets. And by that 24-hour clock that we're showing there, and the meetings and the technology that we use, the blogs, the video conferencing, obviously emails, we keep each other in touch as we pass the book of business around 24 hours each day. Few points that may affect closed-end fund flows. Few valuation drivers, 10 times. Very cheap for emerging markets based upon the fact they've got a far better growth profile than many developed countries have. And the discounts via our closed-end funds are significantly greater than developed market products. We use a lot of technology, as you'd expect. We have a lot of in-house solutions. We have 3 programmers that are working on in-house solutions. We don't use third-party data. Most of the people that do what we do use Morningstar. We don't use Morningstar. We, as I say, have our own data. Huge aversion to risk. I've been around long enough to know that you have to be careful. Don't back your position disproportionately. Don't allow your ego to take over. Remain controlled, very careful. Growth plans, I've talked about some of them. The real growth plans are to move away from emerging markets, move in the direction of developed markets, which could be a much larger asset class as far as we're concerned than emerging. Frontier could be a little bit larger. But then there are a lot of other fixed income closed-end funds, and REITs really are something that we find really quite interesting, particularly emerging market REITs. Many countries are just in the process of introducing REIT legislation, and the bottom line is that we would think that over the next 5 or 10 years, which will see me out because I will have retired, but we think that REITs are going to be a very interesting asset class where we can take advantage of some of the skills that we've developed over the years to value them and trade them. The various products that we offer, client by type. Bear in mind these are all institutions, all in the US, have no European business, no exposure to the euro. Everything is effectively really translated back into sterling for sterling investors, which is where the listing is in London. But that is really a translation of dollars along with the expenses of running the business. Client tenure, something that we're really proud of. Financial data, which is nothing really surprising. We provide quarterly information. History of the business. I originally started a stockbroking business just after Big Bang, and that morphed into an investment management business because fees got narrower and narrower, and the quality of research that we were providing to the clients of the brokerage business was of a very high standard. We thought, oh, why don't we use this ourselves? And that's why the business has developed in the way that it has. Any questions?
When you're trading funds, is it primarily trading to take advantage of widening discounts? Is it fundamental changes in your what's going on within each fund in terms of management? What's the active part of the business?
It's very rarely that it's anything to do with management because the processes that we're looking at are pretty consistent. They, like we, like you, probably have a very formalized investment process, which we're familiar with, which we've been watching for 10, 20 years. So it's not the process itself that we would be investing in or changing our allocation with regard to. It's either countries, because countries have got expensive or cheap, or there's some geopolitical event that is good or bad. But if you look at the attribution of return, and on average we've outperformed our benchmark net of expenses by about 300 basis points on an annual basis. 2/3 of that return has come from trading the discount. So it's, in other words, if you think of it in the context of there are actually two Templeton funds. There's a Templeton Emerging Market Fund here in New York, trades here, and there's one in London. Now you'd think that the discount on those two securities would be identical, because you'd think that there'd be an arbitrage that would be taken away by discerning investors. Portfolios are identical. Well, you can have a 3, sometimes 4, we have had even 500 basis point discount differential between two identical portfolios in terms of their exposure. So trading that sort of thing is really, really neat. You have it with a couple of India funds, same thing. So it's trading discounts to a greater extent that is the major source of alpha generation.
One of the points I want to make before we get more questions. When I first met these guys and talked to them, we know about investing in emerging markets. We've done it for a long time, 20, 25 years. So when I talked to them about investing in closed-end funds, I understand that closed-end funds are a good way to implement investments, value investments in emerging markets. I understand the strategy, it makes perfect sense. But it took me a
we have been buying back our own shares. Yeah, I bought some shares back 2 weeks ago, actually, at 370. Share price today was £4. Yeah, it's a no-brainer. No? We're not smart enough to do better than that, right? I just make the point that Bill was making. The people on the other side of the trades where we're effectively purchasing these securities and selling them are retail. There's very little institutional presence in our marketplace. So the pricing anomalies are based upon, I would say, emotion. It's not really based upon a rigorous analysis of the net asset value, the discount range, the country. Most retail investors just straight over their head. Sorry.
Do you worry about somebody accumulating a large investment in your closed-end fund and trying, of course, to eliminate the closed-end fund?
In our company, do you mean?
I'm sorry?
You mean in our company, in City of London Investment Group?
From the outside. Somebody.
The underlying funds themselves that they're invested in.
No. The fund itself.
Our company, you mean? We don't run a fund, you see. We're running a company.
They are an investment management company.
Our income comes from management fees from clients who are giving us assets to run. So, yeah, we do worry about that, but I think that what they'd find is that they weren't really buying a lot if that happened, because I think staff probably have doubts. Most of our clients would run a mile because they like it the way it is. So there aren't really any complaints at the moment. So I think that someone attempting to take us over, I don't think that would work too well.
Jean-Marie raises a good point, and that is one of the other things that you do is the closed-end funds with which you invest your clients' money. Sometimes you take a more active role in helping to close the discounts
Yeah.
on those funds, besides just waiting for Mr. Market to do it.
There's more of that going on at the moment when discounts are so wide. When discounts are narrow and they're down at 8 or 7 or 6, you're going to get IPOs, you're going to get a refurbishment, you're going to get a revitalization of the industry. When discounts are very wide, the natural thing is, because these things are just being priced like cars and houses and clothing, right? They're just being priced based upon supply and demand. When they're out of favor, you've got to reduce the supply and the price goes up. And closed-end funds are no different from that. Sorry.
May I ask about the proverbial Warren Buffett gets hit by a bus question you must have fielded in the past? You alluded to your own eventual exit from management. What would the implications of a sudden exit of your management stake be?
We've already planned for that. I mean, that's been a 5-year project. As a London-listed company, you have to have disaster recovery, you might call them, business continuity plans in place. They have to be written in stone and they have to be well understood by the non-execs. There is now a deputy CEO. I've passed on my emerging market CIO responsibilities. So we're well down that path. There could be, there could be half a dozen people presenting to you, hopefully roughly the same message as I'm presenting to you now. It's just that I was just down the road, and that's why Bill asked me to come along. So if I'm knocked over by a bus, doesn't make any difference. I own 7% of the shares. I did own 22% of the shares. I've had in the accounts the basis on which I was going to sell shares. Rather than say to everybody, I'm not going to sell my shares, and then all of a sudden selling them and not being able to look anybody in the face, in the accounts it actually says the levels at which I'll sell them. So the share price is now £4, and the next price at which I'll be selling shares is £4.50. So it's sort of all part of a, you could say, cunning, devious plan, but it's all part of a plan. It's all written down. It's all out there. I saw another hand go up, but hi.
The question about your business model, and that's what your value, you obviously are providing a lot of value add to investors. I'm not quite sure what the index, I presume, this is going to be a multi-part question. The index, I presume, you're working off of is some kind of closed-end fund index. But,
No.
Okay, well, you'll correct me on that. But impressionistically, at least for U.S. closed-end funds, the people that populate that universe tend to be, by and large, weak managers. There are some exceptions, but that you're picking, if you work very hard to look through to the management of these closed-end funds, there's not very many that outperform good managers who are doing it in no-load mutual funds with equivalent expense ratios. And so the general question is, what are you doing, if I'm right, and my premise may be just wrong, what's the value proposition for the folks that are entrusting you with money?
Well, I think there's three things. The first is that we don't get measured against emerging market indices. We get measured against the Morgan Stanley Emerging Markets Free or ACWI or some other well-known institutional index, because our peer group is not closed-end fund managers, it's bottom-up stock pickers. So that's the first point. Second point is our managers, have had a job recently to keep up with the benchmark because they're active managers and they suffer from all the points that have been discussed today. But that's not to say that they will continue to underperform. But that underperformance is not of an order of magnitude that make you or I concerned. It might be 1%, and we can more than make up that, and indeed have made up more than that, by sensible country allocation and sensible discount trading between centres. Third point, we run our business based upon a series of what I would best define pods. In other words, when I started the business, it was all emerging. 10 years ago, we said we're going to do developed because emerging had got too big. And you can't continue to make alpha out of owning a disproportionate share of a finite asset class, particularly if discounts are starting to get bigger. So we now have groups, separate groups, that trade emerging market closed-end funds, developed market closed-end funds, frontier, fixed income, and now REITs. And each of those businesses, separate from emerging, which is probably close to being capacity constrained, each of those businesses could grow quite significantly. And I wasn't sure if your question related to a client who might be looking at the value proposition or a shareholder who might be looking at the share.
I was really asking it from the client point of view.
Okay.
Sure.
Well, that would be the first two answers then. It's the indices we use are traditional indices that would be used by any institutional manager. And our ability to add value is, if you look at the attribution of return over 25 years, at the margin, the managers have outperformed. But recently, they've had pretty consistent underperformance, but not of an order of magnitude that we can't make up on the back of the anomalies that there are in the market to take advantage of.
A minor point, but I saw a slide on the risk sheet that said you don't lend your holdings.
Yeah.
I'm curious why.
Well, first, it's very difficult to do that because it's very difficult to. It's retail that's invariably on the other side of the trade, so they're not interested in borrowing stock from us. But I'm always concerned about counterparty risk. In 2008 and 2009, there were 3-month delays with regard to getting stock back and taking advantage of corporate actions. And we'd never, ever lent stock. And it's just a broad principle, like we never, ever had any debt in the business. It's just something that I just closed my eyes to because I'm a really conservative guy. I don't want to get into a position where we can't accept a corporate action because we were in the unfortunate event where we had lent stock to someone and we couldn't get it back in time. Thank you.
All right, so this concludes our organized entertainment for you this morning. I would just point out to you that in the second half of our presentation, we've gone from the excesses, as represented by what Steve talked about, to the very epitome of temperance and moderation and balance and proportion that Barry, and it's Barry himself and the businesses that he runs. We are in emerging markets as a category because they're cheap, and we like Barry's company because it's cheap, and also because it's a very, very good business, and because we think over time the total return from Barry's business will be excellent, as well as all the other things that he talks about. So what we're going to do now is Jason's going to open the doors. We're going to break for lunch, go next door, get some food, come back in here, and then For video entertainment, we've got a little news clip from Australia, which I think you'll find interesting. And then over dessert, we'll do some Q&A. We have some other value investors in the room that hopefully will participate. And so enjoy your lunch. Thank you. We have a few Q&A, and then you're all free to go. I want to introduce Alon Rosen from Oppenheimer, who does a lot of stuff for us. He's very helpful on the brokerage side of things. And Alon, would you tell everybody here what happened to the markets this morning?
Yeah, so I was planning on being here for the presentation. My partner and I both here at PAT Group, strategy and advisor. I run the equity derivatives group at Oppenheimer. And what's going on is a lot of people are freaking out a bit. You know, a lot of growth investors who've made a lot of money, very complacent in September to the point where they weren't thinking about downside, because anything downside lost you money. And they made it really challenging to be bearish. And what we're seeing now is risk management's coming back. Everyone's very scared about 2019, 2020. Oh, sorry. Everyone's very scared about 2019, 2020, and it's time where, you know, bearish views should start to materialize and be able to monetize those. So we've been working closely. Yeah, from you know, I've been able to hear Bill's views every week, and we're ready to make some money.
Thank you. Thank you very much, Alon. Okay, so I wanted to just start out for just in the interest of time. We've been very honored to have Jean-Marie Eviard be an investor and to be sitting at our table. And I wanted him to just talk for a minute about what it was like to be a value investor in the late 1990s. He was running a very successful fund, and I want him to tell you what that was like.
Thank you, Bill. Well, it was very painful. But then I think the reason why there are so few value investors, I mean genuine value investors, you know, some people call themselves value investors, and then value investing becomes unfashionable and they change their tune. And I think it's Jeremy Grantham who got it when he said, hey, there is career risk. In other words, if you're in your mid-30s, man or woman, and you work for, maybe it's not a value shop, or if it's a semi-value shop, and you lie for 6, 12, 18 months. It's not that they cancel your bonus. Maybe they show you the door. So that's why there is career risk. Because the value investor is by definition a long-term investor. That's what, you know, Ben Graham said. Short-term, the stock market is a voting machine. Long-term, it's a weighing machine, which weighs the realities of a business. My wife says I start talking about something and then I cannot get back to what I was saying. So help me.
Well, we were talking about the late 90s.
Right.
And the idea that funds were flowing into tech stocks and were coming out of yours and my long positions that were going down for no good believe me, I know the feeling about not being happy, and it's much more than just a day. All right, so I have a couple of specific issues I wanted to go over, but are there any other questions? I think we talked a little bit about the portfolio. I wanted to have Lilia talk a little bit about our worst performing sector of the portfolio, which in my opinion has probably some of the very best businesses in it. So would you take 30 seconds or a minute and talk about our E&P companies and the shale play and why we think they're so good?
Could I ask you a question about the Australia
Yeah,
situation?
yeah.
Do you see this as impactful to Australia as the 2008 housing crisis was the United States?
No.
If so, are there any knock-on effects beyond the banks in Australia?
Okay, so the short answer is no. I think this is much worse. Much, much worse, because the valuations are much higher and the banks are much, much more exposed. It's a different, somewhat different. It's not subprime. This is the whole banking system and the whole economy, which includes the construction workers, the same numbers we saw here, real estate, brokers, all of that stuff is a huge part of the overall economy. So the short answer, I'm being a little cute, but I think it's worse. And yes, we absolutely think it's going to affect the rest of the economy in a major way. We have a smart bank analyst that we know that talks about the other third of the Australian bank assets besides the 2/3 that are in mortgages. And by the way, we've never seen a banking industry so levered to mortgages. But the other third, he ranks as very low quality loans, and the metrics that he uses show that those businesses that the banks have lent to are also stretched and have all kinds of issues. So the thing that continues to amaze us, and I'll let Steve comment on this as well, there just is absolutely no recognition of what's about this tidal wave that's about to wash over the entire continent. Steve was just down there a couple weeks ago.
Yeah, so one of the big differences between Australia today and the US 10 years ago would be the structure of the mortgage market. So here we had all this intermediation, all these tiny specialized companies, or not tiny, Countrywide and mortgage finance specialists. And so when the bubble popped, those disappeared very quickly. They had it was devastating in the mortgage market. But if you looked at the big national banks, Bank of America, Wells Fargo, JP Morgan, the impact wasn't devastating. They had mortgage portfolios that were substantial but small, and there was real risk controls for the banking system as a whole. It was more this corner of the market really failed. Whereas in Australia, they don't have all these specialized finance companies, but the big national banks themselves are just up to their eyeballs in mortgage risk, and they're extremely weak on the liability side. They're extremely exposed to wholesale financing. A lot of it comes from offshore. All of it's short term, and so they're going to have a national banking crisis that puts what we had in 2008 to shame. So we think if what we think is going to happen, it's going to be really, really ugly. It's going to affect everything. The currency is going to get trashed. The banking system will get wiped out. There'll have to be massive amounts of recapitalization across the financial sector, and it's going to affect everyone. So that's sort of what we see happening in Australia.
This is what we think is going to happen. We may be wrong, and if we're wrong, these banks are already fully priced. We don't think there's much risk. But there is huge leverage to this huge bubble, and it's one of the best shorts I think I've ever seen.
Is there anything in your eyes that precipitates it, or is it just...
Yeah, we talked about the Royal Commission.
But that's already happened.
The Royal Commission happened in the spring, and in China and in Canada had a regulatory change. It's a similar effect. They're tightening the standards for loans. So as the UBS analyst says about the Australian UBS analyst talks about this. He says, housing prices are not a function of supply and demand of houses. Housing prices are a function of the supply and demand of credit. And we know, using normal credit standards in Australia means that there's 30 or 40% less credit that could be extended to the housing market, given the salaries and so on. And so if you take out that amount of credit flow into a hugely overexpensive market, you're starting to see it in the video. Dick.
You showed the picture of $4 million
Canadian banks are not as bad, and there's several things. One is about half of all the mortgages are government guaranteed in Canada. So the government's going to take a hit to some of that. The banks are not nearly as, well, I shouldn't say, they're not as exposed. There's similar stuff going on. There's similar misvaluations. And we think there's some really interesting sort of marginal players in Canada, but the Aussies are our favorite.
Yeah, so in Canada, as Bill said, half the mortgages are guaranteed by the government, and a lot of the mortgage risk is not located in the big national banks. A lot of it is pushed out into more marginal players, which we are also active in. But in Australia, it's a national story in a way that's sort of stunning. So yeah, that's basically the main distinction between the two.
A couple months ago, Steve and I went up to Toronto, and we went around. We looked at some apartments and looked at some houses with brokers. And if anybody wants to see some pictures of some of these, it's not quite as dramatic as the one I showed, but it's pretty interesting, and to listen to the brokers try to explain why this is a good idea, a good investment. We talked about, we didn't say we wanted to live there, we were making these as investments. And the rationale was amusing. Anyway, Lilia, talk about the other thing in Canada, the oil and gas business.
I just want to step back again, and like in my introduction to City of London, I talk about that in any business we look for competitive structures with a long runway of reinvesting opportunities. The same way in energy, we're also looking for the same qualities, and there essentially you want to have a lowest cost producers with at least 15 years worth of inventory on the current production. So that's an idea. And this 3 years ago I started on this project, and literally we went through all North America. We looked at geological maps trying to find the best lowest cost producers. So that's the premise how we came about this sort of area, value investing area. So this sector really hurt us because underlying commodity prices made a U-turn. They were up first 6 months, 15%, and then just since October till I guess now they are down from $76 to $20. But what's hurt us the most is actually our U.S. exposure to three of our U.S. E&P companies. They more or less flat. I wouldn't say they were down. What really hurt us is our Canadian E&P companies. And there, the development was that 3 months ago, there was unexpected pipeline constraints, where right now Canadian oil trading at the big discounts to WTI because it's just heavy oil is trapped in Canada. But the good news is that fundamentals are good. Even if our Canadian stocks down a lot, they don't have exposure to heavy oil. They actually have exposure to condensate and the light oil. And those differentials, they will narrow by the first half of 2019. Yes, that will take time, but first half usually it's a spring breakout session in Canada. So I actually did run the stress test on our cash flow incorporating these big differentials. It's a hit to cash flow, but not huge one. And at the valuation and the growth profile, most of our stocks, they're all small. So that's another element. It's kind of get exponentially, you can see it when something bad, our stocks down 5%. They're down much more. But because they're small and they're lowest cost producers, they're all growing really fast. And cumulatively, I put together our portfolio. Year to date, they'll be growing production 30% altogether, like cumulatively. And then their EBITDA will grow next year 30-40% on 25% production growth. So most of them, with the exception of Source Energy, behave as we were expecting. They're drilling on time and on budget. Their well results perform within type curve. Many actually of them improved on their type curve the wells are much better than they were last year. Yeah, so valuation is around 3 times EBITDA. Next year, I have them leveraging around 1.5 times net debt to EBITDA. And the most important measure that Bill was referring to, we really care about return on investment capital. In energy, this called the recycle ratio. It's essentially what is your profit margins divided by invested capital. And on that measure, all of our stocks have a 3 times recycle ratio, which is a 300% on your invested capital. They are small, they are out of favor, but fundamentals are good. And the same way, I hope that Source Energy will prove up next year themselves, because they signed more contracts and they were able to spread out their rail cost over the bigger volumes. Yeah, if you're interested, I can talk more about it.
So what's the normal recycle?
Normal recycle ratio in North America is around 1.8 times, 1.5. If you have 2 or close to 2, this is amazing. If you have 3, this is exceptional. Like the best in North America, so in US, would be easier to imagine. So the best of the best company in US is Pioneer Natural Resources. They have core of the core. They never bought land. They were lucky to happen to be at the core of the Permian. They never bought it. So on a full cycle recycle ratio, it's 3 times. That's amazing. Yeah.
How does that translate into return on capital?
So our companies, they're so small, they chooses, some of them chooses to outspend their cash flow. They chooses to grow. And then once they stabilize, get some critical mass, they will return high free cash flow. Yeah, it's just a matter of choice. If they grow within cash flow now, you will see positive earnings.
If you strip out the cash flow dedicated to increasing production, if you just look at cash flow to maintain this production, you're talking about what kinds of returns these guys are looking at. So you drill a well and you fully cost it. What are you expecting?
So Tim, part of this is a moving target, because the technology is getting better, the technique is getting better. But the big Canadian holding that we have is doing an IRR of over 100%, right? 100 and something percent. Now that's on the well, it's drilled. It's not on the whole company. They obviously have some assets. And I think on balance, those IRRs for incremental wells drilled will be easily north of 50, and probably some other of these companies have triple-digit IRRs, and yet they're selling at, as Kurt Molnar likes to put it, the highest discount rates in his career. We don't. Some people may not like the industry; they may be worried about the price, but this is really unusual. I've never seen anything like this. Yes.
There's a pipeline issue, I think, of getting oil to the west coast of Canada. How is that going to affect? You said your companies were increasing production, but yet the pipelines
Yeah, so our Canadian companies, they don't have exposure to that heavy oil we're talking about. They produce light oil and condensate, and those products will have a narrowing of differential, because heavy oil will find another ways. They figure out in the next 6 months, 9 months how they're going to get out. They will go on rail. There's other ways to, but they don't have exposure to heavy oil. So
So how does the condensate and the lighter oil get to market? It doesn't go through other.
it's used domestically. It doesn't need to go anywhere from Canada.
These are basically different pipelines, and it's used domestically, so that that particular pipeline is not relevant, and so the differentials. There was also a plant maintenance issue that happened. It's probably about to open up again. So the differentials are larger than they had been. They've been a little larger than we expected, but we think they're going to go back closer to normal. And on those kinds of prices that our companies in Canada will receive, we will expect them to get very high IRRs again. The other thing about Canada, which is interesting, is they've basically put themselves out of business in the natural gas business. AECO prices are, I don't know, $1, $1.50 for natural gas. So this is a country that is, for environmental reasons and because of the First Nation issues, have basically stopped the development of their major asset in Western Canada, which is natural gas, not oil and condensate, which our companies are doing, and they're doing very well. They're fine. But there's a big pool of natural gas that's not being exploited in Canada. We think the politics of this is shifting. We think there's going to be a big shift back towards more positive pipeline kind of regulation. May not happen immediately, but there has just been announced for the first time there's now going to be an LNG plant on the Pacific Ocean. It was just announced a couple weeks ago, but that'll be a few years down the road. All right, any other questions? If not, thank you all very much for coming. We appreciate your support and attendance, and we'll be in touch.